in New York, Francine Lacroix in London. The news flows extraordinary. Francine, we just saw it's like out of Game of Thrones or something. EU diplomatic headlines about crossing red lines. I mean, the whole Brexit thing staggers forward. Is there really a date, 12/31, or can the can migrate into 2021?
I feel like, Tom, first of all, I do miss traveling with you because we always used to talk about this over, Stilton or a glass of wine, but we've never played chess. And this is a chess game, Tom. It's like the biggest chess, game that you'll ever see with very high stakes. Now, we understand that the French are briefing reporters in Brussels, or at least are briefing officials in Brussels on two things. First of all, they won't hesitate, they say, to use a veto if Michel Barnier comes back with the deal that Europe finds too watered down. And the second is that they also think that the EU should be prepared to negotiate into January of 2021, something that the UK has so far refused. Again, according to this EU diplomat, look, fisheries are at a level playing field that's still open. I think, once again, but I've said this 1,055,000 times, the next couple of days will be decisive, unless they extend, which they've also done 1,000,000 times.
Well, maybe it's the Queen's Gambit and the royal family, if after they're done watching the Crown, will step in and try to negotiate this to success. What we've got in the market's fascinating, particularly on strong euro. With our first word news in New York is Ritika Gupta.
Morning, Tom. Francine. House Speaker Nancy Pelosi and Senate Democratic leader Chuck Schumer are now backing a bipartisan stimulus plan. They see the proposal from House and Senate lawmakers as the foundation for a new round of negotiations. The plan calls for $908 billion in spending. That's less than what Democrats want, but an increase from the number being floated by Senate Majority Leader Mitch McConnell. The U.S. has had its deadliest day yet in the pandemic. According to Johns Hopkins University, the number of fatalities went over 2,700 for the first time. Meanwhile, hospitalizations also set a new mark, going over 100,000. California posted a 38% surge in the last week of November. The U.S. has restricted travel visas for millions of members of China's Communist Party. New rules will allow party members and their families to obtain visas good for 1 month. Previously, they could get 10-year visas. The U.S. Embassy in Beijing says China's Communist Party actively tries to influence Americans through propaganda and economic coercion. OPEC and its allies are making progress in talks on oil output cuts. That increases the chance that today's meeting can salvage a deal after failed negotiations earlier this week. One delegate tells Bloomberg discussions are now focusing on proposals for gradual easing of output cuts over several months. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom?
We'll turn to the market, but that really doesn't explain it all. George Saravelis with us the last hour with that strong euro call out to 130. Euro now 121. That's a real jump condition here in euro breaking out of the long-term euro weakness that we've seen. NYMEX crude, Javier Blas with us in the last hour talking about demand dynamics, important OPEC meetings to come as well. And I guess if I had to feature one thing again, it'd be the Pacific Rim, where ADXY, that blended Pacific Rim ex-Japan index, indicates further Pacific Rim strength against dollar. Francine?
Yeah, Tom, global stocks are pausing near these all-time highs. A lot of the questions will be on, how quickly the vaccine can get people spending again. Speaking of spending, Tom, I haven't even asked you whether you've bought your Christmas shopping yet. I know your birthday's also coming up, but that's maybe a conversation for another day. What else I'm looking at is pound rebounding, traders taking in stride France's threat to veto a UK-EU trade deal if it doesn't like the terms. And then, as you were saying, Tom, the dollar's added to the slump this week, but it's also sent euro, Australian dollar, Korean won to their highest levels versus the dollar in more than 2 years. Very clearly, I also want to show you Swiss franc at the strongest since 2015. I'll add it to the data check. Yeah. It just caught my attention.
Yeah, I see that with Euro Swissy particularly backing up over the last number of days. Weaker Swiss franc. Francine, today is the cutting of the Christmas tree. We'll be going out to what's called the Ramble in Central Park and trying to find something more reasonable this year. I'm thinking 6 feet, maybe 7 feet. out in Central Park. And, well, you know, sometimes there's an owl in there. You never know. Just like Mr. Chase had in the Christmas Vacation movie. Right now, she's seen Christmas Vacation 14 times. Emily Wilkins joins us. She is in Atlanta, as there are 2 Senate races there, our government congressional campaigns reporter. Emily, good morning. What has changed in the last 24 hours for these 4 senatorial candidates?
I'm not sure about what exactly has changed, but Republicans in Georgia are beginning to get nervous. A lot of Trump supporters are believing the president's allegations that there was widespread fraud, and now a number of them seem like they're not going to show up to vote in the runoff. So the Republicans, they're bringing in the big guns on this one. Mike Pence is heading down here tomorrow. Trump will be here on Saturday. They're going to try and really rally and rile the base to make sure that they get out to vote in an election where Trump is not on the ballot.
All the focus seems to be on the Republicans. What is the Democrat plan?
Democrats are basically doing a lot of what they did during the general election. They're doing a lot of outreach in the suburban Atlanta area. That's where they found a ton of new voters. They're appealing to Asian voters, Hispanic voters, Black voters. These are all groups that came out in a big way and helped drive both of these races into a runoff.
Emily, how's the fundraising? First of all, good morning. But how's President Trump doing in fundraising?
So this is really interesting. Trump has raised more than $100 million since Election Day. He says that it's for preventing election fraud, kind of, challenging court cases. But a lot of this money is going into a fund that Trump will be able to use to continue his political influence after leaving office. This isn't something that's uncommon for politicians to have, but it basically means that he's saying, hey, give me money for this recount, and then that can show up later if Trump wants to go ahead and, say, back various candidates for various offices.
But do we know why he's raising so much money? I mean, do people believe, the claims that there's still election fraud? Yes,
there are definitely people who believe claims of election fraud. I will say that it is among Republican leaders, among senators, among top state officials. We are seeing less people willing to go along with Trump's narrative that the election was stolen from him. We're seeing more and more Republicans come out and say, hey, it's going to be President-elect Biden, and we need to support him.
Emily, what happens in the Atlanta suburbs? I mean, I get the polarity between Atlanta and maybe Savannah and a few other geographies in the rest of Georgia, but go more micro on that. Split up Atlanta in what you and Kevin Cirilli are focused on.
So the story of the Atlanta suburbs is a bit of the story of the suburbs in general across the United States. We've seen them simply trend more towards Democrats in the last several years. Part of that was naturally already happening, but another part of that happened because a lot of college-educated voters did not like President Trump and were eager to sort of put a check on him in office and then vote him out of office. But the reason that the Atlanta suburbs in particular are interesting is because of how diverse they are. And that diversity has really gone to the benefit of Democratic candidates in 2018 and again in 2020.
Yeah, but this is important. I mean, Trump's gone. Let's assume that. Trump is gone. What's their motivation to show up? And what the motivation of Democrat or independent-leaning people in those suburbs? Do they have the same disinterest you speak of in the Republicans?
Honestly, Tom, I don't think Trump is gone yet. I mean, the rallies that I've been to, the speeches that I've seen, the people who I've talked to, Trump continues to come up as a motivating factor for people. They either want to make sure that Trump doesn't come back, or they're trying to sort of tie Trump's influence into other individuals like Senate Majority Leader Mitch McConnell.
Emily, thank you so much. Emily Wilkins in Atlanta, of course, these elections coming up here, 2 elections in Georgia. Usually with Jack Lew, there are 14 things to talk about. This time around, there is only one topic, and it has to do with his former job with the government as Treasury Secretary. There's no other topic. Jack Lew on stimulus. We do that next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Surveillance. Good morning, everyone. It is that time of year where we reset and look back. And of course, this year, this exhausting year, we look back and it has been something, and try to look forward with smart conversation. George Saravelis with us earlier of Deutsche Bank. And I want to show a chart before we get to Charles Cantor of Neuberger Berman, who has been wonderful about being in this market. This is the most painful chart for the bears. It is the drop of the Q4 2018, the pandemic plunge, and buttressed up there is a correction in bear market with 18 reasons to not participate in the markets. And of course, we've worked out to new highs. Charles Cantor of Neuberger Berman has participated. Charles, you have been wonderful about you've got to be in the markets to play. How do you have confidence to be in the markets forward to 2021?
I would say, good morning, Tom. I would say never underestimate the ingenuity of corporate management, the ability to adapt to the environment, and because of their agility and adaptability, that produced much more earnings than folks have estimated. And so, you know, fear is a healthy construct to make attractive risk-adjusted returns. There was no shortage of fear. I think folks questioned innovation and the spirit of the U.S. and its ability to deliver a vaccine. And here we are, as we kind of light the Christmas tree last night in Rock Center. We have a vaccine. We have some clarity around the election. And I think you're going to get a very powerful rebound in earnings as you look forward.
The Lemmings bet right now, Mr. Cantor, is everything will rotate out of tech over onto cyclical materials, etc. All my radar is up. How will technology do?
Look, I think that's a fair observation. Values underperform growth now for just 10 years. Mean reversion is a powerful force, and I think the question will be for how long. My guess it'll continue for a little while here, driven by the rebound in cyclical earnings. But as you know, we try and take a longer term view, and that's more measured in 3 and 5 year increments. And when you look at earnings growth over the next 3 years, I think you'll come to appreciate that technology software earnings growth will be significantly greater than cyclical earnings growth over a 3 year period. Over a 1 year period, I think you're going to get a dramatic rebound in industrial and cyclical earnings. But I wouldn't bet against software and technology over the next 3 years, but this rotation into value will continue a while. Of course, folks first cover their value shorts before they buy value. And so, you know, be patient with your fantastic companies that prove to be beyond resilient and powerful. And a little pause here is healthy for everyone.
Charles, good morning from London. What happens if the Biden administration breaks up or tries to dismantle some of these technology giants?
Look, there's always regulatory risk out there, Francine, as you know, and intervention into financial markets can cause disruption into all types of businesses including those that sit at the epicenter of how we've adapted and grown within the construct of the coronavirus. My sense is there'll be actually less action than hoopla. The headlines will seem scarier than the actual implementation, but I think we got to wait a little while before we get a proper read on the things that form the top 3 action items from the Biden administration.
Charles, what do you do with inflation in this kind of environment? So, the earnings could be supported because of the recovery thanks to a vaccine in 2021. But what are the things that could actually hurt what companies are trying to do?
Look, I think what hurts companies over long periods of time is just a misallocation of scarce resources or capital. We're in an environment now where capital is plentiful and interest rates are incredibly low. And I think you're starting to see companies think very strategically about where they're going to place their chess pieces on the board. You've seen a dramatic pickup in M&A. We've lost a couple of our favorite companies just this month through both a strategic merger and a takeout. And so I think the risk is always that company executives feeling confident around the election being behind them, feeling that there's tremendous pent-up demand in the economy to kind of return to normal, and with very low interest rates, make some bold and acquisitions that turn out, not to produce what investors would want. I think that's always the risk, especially the risk as confidence levels rebound, everywhere.
Charles, I've got to ask you about young Benioff in Slack. You go down the income statement of Slack, and I get it. It's a technological capture, it's a revenue build, and frankly, that's all there is to it. Rationalize for our audience these transactions based on a hope and a dream of profit.
That's a tough one for us to wrap our heads around. I think what's almost astonishing is Salesforce has lost, over the last 3 or 4 days, more in market value than the purchase price for Slack. And by the way, the purchase price for Slack is eye-popping. And so I think it highlights, this corporate CEOs balance this fear and greed thing. And clearly they're fearful that they're going to miss out on an important, long-term trend. They see what Microsoft Office is doing with Teams. I'm sure they're getting called from their sales folks that we need something that can compete with, Microsoft, and off they go and make, on a valuation basis,
right,
an eye-popping number that I think will be very difficult to prove out through a financial model. Maybe over time they can prove it out strategically, right. But the benefit of doubt sits squarely against them.
Okay, Charles, you mentioned the Christmas tree lighting last night. Look, you and I knew Comcast when it was in development. And one day the Roberts family flipped it to being cash flow positive, and off they went. You did Whole Foods with a net income margin like Salesforce of 3 cents on the dollar. Do you just assume someday a Dow component like Salesforce can flip like the Roberts family to some form of cash flow generation?
You would hope so, but just simply milking businesses for cash don't create a lot of entrepreneurial spirit inside corporate C-suites. And that's why I come back to this capital allocation question. What is boring is likely good for shareholders, but less interesting strategically for management teams. At some point, you would hope that they get the message, but don't forget, as you think through technology, the rate of change there is just breathtaking. And Salesforce would certainly not want to wake up and believe they Kodak or IBM. And by that, I mean they simply don't transition to where the puck's going and stay grounded in this idea that they just got to milk current cash flows. So it's a delicate balance, of course, Tom. It's always a little gray, and the fear of actually just being stuck in the mud is probably greater than the opportunity to try and prove out something audacious as Salesforce is trying to do.
Brilliant. Charles Cantor, hugely valuable. Thank you so much. Greatly appreciate it this morning. There on Mr. Benioff, Salesforce, and a modest transaction. Speaking of that, Mr. Butterfield riding high, the Slack CEO tonight, 5 p.m. Emily Chang will grill Stuart Butterfield. She will show no slack. This is Bloomberg.
So the reason we're interested in Post Office Rock is just the extreme nature of the erosion that is ongoing here. In the last, well, since 1940, it's eroded about 100 meters and in quite a unique fashion. By having a map of the seafloor and hopefully being able to capture some movement in these transverse dunes, we'll be able to see after the erosion where the sand is going and why it is not replenishing the coast as sometimes and most often happens.
With continued sea level rise and future climate change, we're just going to see much more of this kind of event taking place. So it's a good proxy of what we expect to take place much more commonly by 2050, 2100 than is currently the case.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. United Parcel Service is trying to keep from being overwhelmed by the holiday rush. UPS is temporarily restricting some packages it takes from big retailers such as Nike, Gap, and LL Bean. The company says it's steering large customers to ship on days when volume isn't as heavy. The Australian bank Macquarie is expanding its asset management business in the US. Macquarie has agreed to buy Waddell & Reed Financial for $1.7 billion. The American company has $68 billion in assets under management. The deal will propel Macquarie into the top 25 actively managed long-term open-ended mutual fund managers. And one by one, the US dollar is dropping to multi-year lows against its peers. This week, the euro, the Canadian and Australian dollars and the Korean won have all hit their highest levels in more than 2 years. The Swiss franc is at its strongest against the dollar since 2015. Growing optimism about a US stimulus and the rollout of vaccines have hurt demand for the world's reserve currency. And that is your latest Bloomberg Business Flash. Francine?
Thank you so much, Ritika. Now, the focus is on the markets, and the focus is not only on dollar, a bit of pressure on some of these stocks because of the records that we've seen, but it's firmly on euro sterling or sterling cable against the dollar. Now, this is, of course, after France has floated this veto threat on a Brexit deal. If its chief negotiator, Michel Barnier, doesn't come out with something that's more convincing. We also know that the French are briefing in Brussels saying they'll be okay to push things back a little if it means getting a better deal, Tom. So there's a bit of nervousness in the markets about what exactly that means.
Well, the churn within Europe and, of course, the wall of money driving euro higher here has been the theme for the day. Continued red and green on the screen. I would actually suggest there's a little bit of a bid to equities here over the last number of minutes. Coming up, our conversation of the day, the former Treasury Secretary of the United States. This is Bloomberg.
सिर्फ और सिर्फ इस इलाके में ड्रिप इरिगेशन सिस्टम की वजह से है और इससे हमारा मुस्तकबिल भी और इससे हम फ़ायदा भी ले रहे हैं।
तकरीबन 20,000 स्क्वायर किलोमीटर लैंड जो है वो अबंडेंट पड़ी है, जिस पे कुछ भी एग्रीकल्चर टेक्निकल तरीके से नहीं हो रही।
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
There are many sectors that could use some help. I would start with the labor market. I think we ought to remember that despite the rapid progress in getting people back to work, which is so welcome, there's still 10 million people who are out of work because of the pandemic. There are just a lot of smaller businesses in their communities that will struggle to make it through this winter. COVID is moving up, and the cold weather, people are staying in, and it's going to be tough on a lot of small businesses.
The chairman of the Federal Reserve System there. We welcome all of you worldwide and across this nation. Without question, our conversation of the day on the financial state of this nation. Jacob Lew is a former U.S. Treasury Secretary. Jack Lew, working with Moakley and O'Neill in the trenches of Massachusetts politics, has gone on to a storied career in Washington, and we're thrilled that he could join us this morning. I must ask, Mr. Secretary, have you been contacted by the Biden administration about service there, as we've seen from Vice President Kerry?
I have a lot of friends who are going to be in the new administration from the top through the leadership levels. I'm happy to offer my advice whenever asked, and will continue to do so.
Let us speak of stimulus, Jack Lew, as we can. In the Friedman article in the New York Times, the president-elect makes clear he's willing to compromise with McConnell. He does not want to embarrass McConnell. What is the common ground that they can find quickly on stimulus?
Tom, the common ground has been clear for a very long time, and finally, in the last, we've seen a conversation beginning looking to find it. Since the expiration of extended and supplemental unemployment benefits, since the expiration of protections on eviction, we've seen a train coming right at us, and it's been far too long since Congress has had a serious conversation. The House passed legislation in May, and we've seen virtually nothing since then. Let's just remember what the facts are, and Chairman Powell described it so well in those opening comments. With nearly 10 million people unemployed, and a large fraction of them, 5 to 10 million people facing eviction, the degree of crisis here is not small. It's very large. It's large in macro terms, and it's just enormous in terms of personal terms. If people lose their homes, if people are homeless at the end of this crisis, their recovery period will not be months. It will be very long, and it will be very hard. That is going to be a social problem and an economic problem. So Congress has to deal now, before the inauguration, with the multiple challenges of keeping people in their homes with eviction protection, giving them support to pay mortgages and rent, helping keep food on the table through a combination of unemployment benefits and food assistance, and dealing with the problems at state and local government, which are going to mean a cutback in services and a loss of employment at the worst time. We went through the last high point of the COVID crisis, the low point of the economy, with enormous government support. That's over. So if we go through the long, hard winter that we see ahead without additional support, it's a long time before January, February.
Mr. Secretary, how do we span the great distrust of the rural-urban divide in this nation? You have tackled that for years, again, going back to the Commonwealth of Massachusetts ages ago. There's just an immense distrust of those cities and those Democrats. It's right out of the 19th century. How do we break that distrust and come to meaningful compromise?
It's a good question, Tom. And, you know, it used to be that food assistance was one of the areas that brought people together. You know, the original food stamp program was a compromise between the agricultural community and people advocating on behalf of poor people. We could see something like that again. The truth of the matter is, working people, regardless of whether they live in cities or in rural areas, face common challenges. You look at the team that President-elect Biden has put together, it's a group of people who focus on what does it take to make work produce a decent standard of living for people, regardless of where they live. Starting with Janet Yellen and her deputy, Wally Adeyemo, the chair of the Council of Economic Advisors, Cecilia Rouse, the head of the Office of Management and Budget, Neera Tanden. These are all people who understand the problems that working people face, whether they're in cities or in rural areas. I hope we can begin that conversation, that their life experiences help them to connect with people both in the communities where people like you and I live, and in rural areas where the problems are not as different as they seem.
But Jack Lew, going back to the stimulus, and good morning to you, are you worried that Republicans are rediscovering their traditional concerns over debt and thus won't do enough on stimulus?
So, Francine, you know, I've spent most of my career trying to strike the right balance between government having the resources to do what it needs in a fiscally responsible way to make this a better country, and at times of crisis, saying we need to do what it takes to get through the crisis. This is a moment of crisis. This is a time when we should not be worrying about $100 billion here or 100 there. My own view is the bigger the better, but big is better than nothing. So I'm glad there's a conversation going on. The content of it matters. The fact that they're now talking about targeting money along the lines of the bipartisan compromise of where it's most needed and not in the places that are inefficient, that makes it possible to have a very effective package at a size that's somewhat smaller. But this is not the moment to be worrying about the deficit. That moment will come. It came and passed when the tax bill was enacted a couple of years ago, when it was almost $2 trillion for, in my view, very inefficient and unfair tax policies that added $2 trillion to the debt in a period of growth. We're in the worst economic period in my lifetime, and this is the moment to use fiscal resources. So I would go bigger now rather than smaller. And when the crisis is over, talk in a reasonable way about how to get back to a sustainable path. And I just want to be clear, the crisis being over is when most of those 10 million people are getting back to work and the unemployment rate is starting to look the way it did before COVID.
But do you think in your eyes that they're worried about debt, which in your eyes you think is wrong, or do they not want to give a win for the Democrats?
Oh, there's certainly politics going on with the Georgia elections in January. Frankly, it could cut both ways. You know, it's hard for me to understand how it helps somebody running in an election now to say to people who are scared that they're going to lose their homes, we're not willing to do anything for you. So I don't fully understand the politics, but obviously it is a factor. In terms of the economy and the impact of debt on the economy, the total debt stock is growing. It's larger now than it's been since World War II. It's also the worst economic crisis we've had since then. And the reality is, this is not the moment to worry. The time to worry is when we get through this crisis. I don't think Chairman Powell would be talking about the need for fiscal stimulus the way he has been, even the way he did yesterday, if it was not a question that people responsible for economic stewardship on both sides who are taking what I think is a reasonable view are thinking. That doesn't mean there's not a serious issue in terms of not having sufficient revenue to meet the spending requirements that our country needs, and in some cases not taking a hard enough view on some of the spending issues.
Jack Lew, I want to go searching for the middle. Some would suggest that the president-elect, with his August age, is the last of a generation. You were weaned by Joe Moakley, who was an on-the-ground South Boston down to Brockton congressman. How do we find the Moakley middle, whether Democrat or Republican?
Look, you know, I came to Washington in the 1970s, and it feels like centuries ago. But I just want to remind everyone that the 1980s and the 1990s were considered the most partisan era that we'd ever gone through. Going a little beyond the years when I worked for Congressman Moakley, the years I worked for Speaker O'Neill, the battles in 1980 to 82 between O'Neill and Reagan were considered hyper-partisan. What happened in 1982 was a congressional election that divided government, that told both men that the only way to make progress is to do it together. I want to be clear. Speaker O'Neill did not obstruct President Reagan. He lost in the votes. That's a big difference. Mitch McConnell is obstructing votes. If Mitch McConnell would allow a majority to vote, we could actually see bipartisan action on stimulus, on issues like immigration. So the challenge here is to get back to a tradition that bipartisan majorities have to act, not running the House and the Senate as a machine to produce primary safety in one or another party and to secure a majority at the cost of functioning government. Gridlock will hurt our country if that's where we go again. And I think that President-elect Biden knows how to compromise. He knows how to do it in an honorable way for both sides. And Mitch McConnell knows how to do that also if he decides it's in his interest. I dearly hope that he decides it's in his interest. I don't think he wants to be remembered in his final years as majority leader, or I hope minority leader, as being an obstructionist. This country voted for people to work together, and Congress needs to let that happen.
Jack Lew with us, and we will continue. We're thrilled that he's with us extensively in this half hour, and we'll talk of China here next. Coming up later on these equity markets, red and green on the screen, NASDAQ 100 out to Dwyer-like levels. Anthony Dwyer will join us with Canaccord Genuity. Please stay with us with Jack Lew. This is Bloomberg. Good morning.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. With us, the former Treasury Secretary of the United States, Jacob Lew. Jack Lew, an extraordinary event today, wherein, and this coming from Axios in their morning note, John Radcliffe of Texas, now our Director of Intelligence, will make direct and public comments on China. It's just one sense of the discourse of this present administration versus where the president-elect may lead us. What is the appropriate tone that President Biden needs on China if he and Mr. Trump are on common grounds about distrust over trade and tariff?
So, Tom, the challenges of dealing with China are great. And China's growing economy, their growing power in the region and around the world, is something that any American president is going to have to take very seriously. My own view, and I think the view of the incoming administration, is that that will be done most effectively if America is not going head-to-head with China on every issue, but bringing our allies together to set global standards amongst the countries of the world that China wants to interact with economically and in other ways, and to do it in a way where the pressure on China is greater than if it's just a head-to-head contact. You know, candidly, the tone of rhetoric makes a difference. You cannot talk to a great power in terms that at best are negative, at worst are racist language, and expect to have any kind of a civil discourse. That doesn't explain away the bad behavior, either economically or in terms of human rights or other challenges that we have to deal with China. It's just not a way those problems are going to be solved. Ultimately, China, like any country, will act in its own best interest. If it understands its own best interest to make the kinds of changes that will make the threats and the risks that we face easier for us to deal with, that will lead to more progress. But to be clear, a lot of the responsibility is what we do here at home. How do we invest in American technology and American competitiveness if China has a product to expand 5G and we don't around the world, it's half the problem the way China does it, and it's half that we're not out there competing. And we need to work either on our own or with our closest allies to make sure that there are alternatives.
Jack Lew, the memory here, which is distant now, I don't know, I can't do the math, 11 years later, is the success of G20 Pittsburgh. You were very much involved in that. Are our multilateral efforts dead? Have we so shattered them with President Trump that we cannot get back to some sense of that success of Pittsburgh long ago?
I hope not, Tom, because I think the future for our security and stability is much brighter if we get back to working with our traditional alliances and new alliances that meet the needs of the 21st century. The reality is we are stronger when we have a relationship with our European allies that for the last 70 years has made it unthinkable that there would be a threat on our shores. We're stronger if we have the largest trading relationship with like-minded countries in Europe. I could make a similar case in Asia. China will not stop if we step back from working with the world. If the rules of the future are written or suspended because of the way that relationship evolves, America will be stronger, not weaker. Now, I think the foreign policy team that the president-elect has put together is committed to pursuing these kinds of associations, these alliances, in a way that always puts first what's good for the American economy, for the American working person. We have to do that. But that's different from saying we're going to go it alone. Going it alone is not the way we're going to be strong.
Jack Lew, what do you think are the top three challenges for Janet Yellen?
So, look, I think Janet is an outstanding selection for the Treasury Department. She brings a combination of experience and expertise, demeanor, relationships of trust, and the ability to teach and explain in a way that will maybe help bridge some of the partisan gap. Because let's remember, it's not 50 people she needs to convince in order to make sure we can have a majority supporting policies. The challenge starts with the health crisis and the economic crisis flowing from it. That's job one. And as I mentioned earlier, I think that really needs to begin even before Inauguration Day. After that, there's the job of rebuilding the economy. Remember, we don't come out of this back where we started. And where we started, there were many problems. So I think an investment program in the kinds of infrastructure, the kinds of support for working people to have opportunity is going to be essential. And I think you go beyond that, the international issues will be very real. This crisis is cascaded around the world, and the United States has to resume its leadership around the world because the vacuum, Tom asked about Pittsburgh, where has the United States been in the last 9 months leading the world to deal with the crisis beyond anything that we've dealt with in my lifetime? We need to be back there.
Thank you so much for talking to us this morning. Jacob Lew there, the former U.S. Treasury Secretary. Now, coming up, we talk and track COVID-19. We talk about the pandemic, the vaccine, hospitalizations with Jason Farley, Johns Hopkins University nursing professor. That's coming up next, and this is Bloomberg.
have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed this unique partnership with the leading authority on COVID-19. And of course, you know by now, every day we bring you insight from experts in public health, infectious disease and emergency preparedness. And we're grateful to Johns Hopkins for giving us experts each and every day. Joining us now is Jason Farley. He's Johns Hopkins nursing professor. Professor Farley, when you look at the number of deaths in the U.S., climbing and climbing, it is pretty horrific. What will it take for this to stop? Is a vaccine the only way to getting a true handle on this?
Well, good morning. I wouldn't say, absolutely a vaccine is certainly a great step in the right direction. It is not the only way. We saw with our first wave of this infection prior to the summer that, very strong measures, stay-at-home orders, the mask requirements, the ordinances of curfews and those types of things was effective as social measures and public health measures. So it's not the only way. And frankly, we won't have enough doses for it to be the only way. So it has to be a combination.
When will we see the first approval in the U.S.? And how quickly can we see an approval of 2 vaccines, 3 vaccines?
Yeah, certainly. Well, there's lots of speculation that the first approval will be sometime before the end of the year. The FDA has 2 meetings currently planned, one on the 10th of December for the Pfizer BioNTech vaccine, and the second on the 17th of December for the Moderna vaccine. Those are open to the public. Anyone can go and live stream them, and they will be televised a variety of streaming channels. So you can find out exactly what's happening on those vaccines. We do believe once the data is in and is reviewed, however, it generally takes, obviously they're fast tracking, but typical process is not in play here. This would normally be months and months of review. Now they're looking at really trying to fast track these and review the data as fast as possible. So it is within, but it is potentially, I would say, plausible that one of them could be approved by the end of the year and possibly a second or early in 2021.
Jason, once these are approved, does the U.S. have a proper infrastructure in place to distribute and vaccinate quickly?
Well, given who the initial recommendations have been to vaccinate, those in long-term care facilities and frontline health workers, at least from the CDC's Tier 1 vaccine schedule, the answer to that is probably yes. My biggest concern with these vaccines is their cold chain requirements. So they have to be stored in refrigerators, freezers, and so even up to the point of giving the doses. So many pharmacies across the country are scaling up, trying to get these types of refrigeration capacities, freezing capacity, which they don't currently have. But at hospitals and potentially at some long-term care, not all facilities, they may have this capacity to store the vaccine up until the point that it's administered. So that will be a really key issue with these two first vaccines.
One, Jason, I mean, how contentious will it be who gets the vaccine first? Is there a clear plan on who should get access so that you reach herd immunity quicker?
Yeah, well, it would definitely be a passive form of immunity through vaccination, not herd immunity, obviously, because herd immunity implies people are being infected and a great number of people infected. But I would say that in terms of the vaccine prioritization, there's been a lot of reporting around this from various, the National Academy of Medicine and other groups. CDC just came out with new recommendations to say how they're going to tier the response after long-term care facilities and frontline workers. They would move into people with comorbidities who are over the age of 65, and then after that, people without comorbidities in that age group, and then eventually the general population.
Jason, thank you so much. Jason Farley there of Johns Hopkins. Be sure to check out VRUS Go on the Bloomberg terminal. Coming up, more Bloomberg surveillance.
The pandemic swells the gap between the rich and poor around the world. There may be no starker case of inequality than Venezuela, where the socialist leader Nicolás Maduro has kept his hold on power by fostering a Darwinian dollarization under quarantine. The nation's mighty oil industry has collapsed. Water, electricity, and gasoline are barely available, and hunger hunts vast portions of the population. 4 out of 5 Venezuelans can't afford a basic food basket last year, according to a research by the main universities. Meanwhile, Caracas neighborhoods have a dozen new delivery services bringing to their doors everything from truffle salmon poke bowls to electronic cigarettes and $50 gluten-free birthday cakes.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
The world is desperate for yield. The world is desperate for income.
With vaccines in sight, there is much hope.
Entrepreneurial America
will come back.
There's pent-up demand for, for getting out of the house.
There's an enormous amount of stimulus that has yet to be spent.
Even though 2021 is supposed to be a good year, you may start off in a deep hole.
By the end of this month, the market will be very overbought. The breadth will start to narrow.
Certainly some support is going to be needed going forward.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. With equity futures going nowhere, Tom, we've got to get serious off the top. This equity market's been setting record after record over the last month. This pandemic is setting all kinds of the wrong kind of records in the United States of America in the last 24 hours.
There's been an abrupt shift, and what's interesting about it, John, is the micro part of it, the micro analysis of France or Germany, and certainly of the United States, leads to interesting conclusions. Here's what matters, John: hospitalization capacity. And the number of deaths is front and center for the pros.
And for market participants, what, Tom? Desensitized by the numbers, conditioned by the experience of earlier this spring, conditioned by the experience that markets go up, and if they don't, policymakers step back in. Isn't that the story right now? Financial markets priced in a better 2021 with the belief that even if we do face bigger risks in the near term, policymakers step back in.
I thought Charles Cantor was brilliant with Neuberger Berman in our last hour, John. It's real simple here. Yes, all of that is true, but he also noted a society adapting and adjusting. And whether it's the adaptation of stimulus, maybe, the adaptation of a vaccine or set of vaccines, maybe, but also the Bloomberg world, corporations adjusting to try to get out to that better 2021.
Well, let's hope we get some better economic data. 8:30 Eastern. Lisa Abramowitz, initial jobless claims just around the corner.
Yeah, and we'll be watching that just to pick up on what Tom was saying. The adjustment, read job cuts, and we got that out from 3M this morning, this idea that they're going to cut 3% of their staff, 2,900 jobs. And this just comes amid this concern, John, to your point, how much can we see these terrible pandemic numbers without longer-term impact on that future outlook in 2021? I just want to whip through what I'm looking at today. At 8 a.m., we're going to be getting the rest of the OPEC Plus meeting on output cuts. Basically, a theory here at this point is there is some consensus coming together to slowly taper the output cuts over time. And we're definitely seeing a minor reaction in oil markets, but not like we saw earlier in the week. 8:30 a.m., what you're talking about, U.S. initial jobless claims. The expectation is 775,000. This is just basically flat on last week. But as you can see, we're still at a very high level. And I'm really wondering how messy this data is. At this point, market participants have been shrugging it off. A lot of asterisks around it, given the pandemic and overcounting. And 10 a.m., we're going to get a read on this higher frequency data, U.S. November ISM service PMIs. I actually am most interested in this. How much are the service sectors being affected by those terrible numbers and record-breaking figures out of the virus reality in America today, John?
Manufacturing ISM earlier this week was solid. I'm with you, Lisa. Look out for that, 10 a.m. Eastern. Tom Keene, initial jobless claims, 700K. Don't get used to that. Feel uncomfortable with that number. You should not be comfortable with 700,000. We were getting comfortable with 200K at the start of this year, Tom. 700K is an ugly number still.
Oh, we're advantaged by Michael McKee, will be here with an original report at 8:30, John. There's no idea what those numbers are going to be or how they're constructed. What's fascinating to me about the labor economy, John, is when it changes and it gets worse, how will the markets react? I think that's the huge mystery into January and, frankly, into first quarter of next year.
The data 90 minutes away. Here's the price action this Thursday morning. The shape of things as follows. Equity futures doing absolutely nothing on the S&P 500. Up 2 points near all-time highs. In the FX market, it gets interesting. Euro dollar with a 121 handle. When do they start to make the noise? When do they step in and say, we don't like this? The we being the ECB. Look out for that. In the bond market, yields up this week. It's been a big move. 0.93% is where the 10-year is right now, to be precise. 0.9277. Big move, Tom Keene. In the bond market, yields up. yields higher, and a real debate in this market as to whether the Fed will tolerate that move or whether they'll step in the next couple of weeks.
John, you wonder how the bond market folds in, and I know our guest is going to get to this on equities as well. John, to put the euro in perspective, it's at 2.7 standard deviations. That is a massive jump condition in strong euro on a short-term basis. And as you know, John, there's winners there and there's losers.
And it's not just about the level, it's about the pace, which is what you're indicating, Tom. We'll catch up with Kit Dukes of SocGen a little bit later. We can catch up with Tony Dwyer right now, Canaccord Genuity equity strategist. Tony, are you starting to feel uncomfortable with where this market is right now, given what is going around all around the world around us, in Europe, in the United States, even more so in the last 24 hours?
It just is, it's disheartening to hear, but it just goes to show what drives the market is money. It's always driven the market. And it's, unfortunately, the social side of it isn't as important as the excess liquidity side of it. And the excess liquidity side of it, as you guys know, is absolutely extraordinary. But just a quick comment, John, on the dollar. So if you look back over the last, since 2009, since the great financial crisis, there's been 3 other periods of such a pronouncedly weak dollar. Historically, when it gets down more than 8%, which it did in the summertime, it ends up going down between 13 to 17%. And of course, I'm talking about the US dollar index. And the reason that that's important is people always try to make it about deficits and excess debt. And what it always comes down to is the dollar gets weaker in that second leg lower, where it goes down into the mid-teens, because it starts to understand and accept that there is a synchronized global recovery. And that, I believe, is the movement of the dollar versus some kind of panic over Brexit or panic over excess debt.
Tony, good morning. Your number one call is own stocks until there's a recession. Are you going to sell stocks because you see a recession coming?
Tom, we are in the beginning of a new economic and market cycle. If you look back at how the market's acting and how all the indicators are acting, it's very similar to what happened toward the end of 2009, where you had if I take you back there was historic excess liquidity, just like there is now, and you had this synchronized global recovery coming out of the great financial crisis. So even though the market was up 50% in the summertime of 2009, it kept going up because there was this excess liquidity and this understanding that the globe was recovering all at the same time. And that's been the impact of the pandemic globally, is that everything shut down in March, like the whole world shut down. And now we're coming off of that low, although, obviously there's going to be fits and starts over the very near term here.
So a lot of equity strategists, yourself included, have been pointing to signs of euphoria, extreme buying, particularly in this moment, based on those terrible numbers that we're getting out of hospitals and deaths on the heels of the COVID pandemic. What do you do as a longer-term investor? Do you just ignore it and basically say, long-term, it's all going to work out, or do you try to play this in the real time?
Lisa, I'm not very good at chasing excessive optimism and strength. And again, it's not a sign that we're about to collapse. Going back to Tom's question, the only time you really get sustainably defensive on equities, in other words, sell, is when you can predict a recession's coming, and you can do that through the yield curve. When you have an inversion of the yield curve, it's one of the reasons we downgraded the market in January of this year. The yield curve, remember the yield curve had inverted last August? So Lisa, the yield curve is just steepening, right? That's the sign, just like it's a sign of a recession is coming when it inverts. When it goes from an inversion back to a positive slope, it's a sign of economic activity. So our play is to buy periods of weakness, like the September swoon, where the S&P was down 10%, and the October whoosh, where the market was down 8% in 2 weeks. Those are the kind of environments where I think you want to attack the opportunity versus feeling like you're quote unquote missing something and chasing this kind of optimism that's out there.
Tony, isn't that a story for everyone, though? Everyone's waiting for the pullback to buy. Everyone's got the same trade on right now. I'm trying to work out what would test the patience of this market at the moment to actually lead to some kind of pullback. The data's been soft on claims over the last couple of weeks. Maybe it's softer again this morning as well. It just seems to me that everything is so firmly anchored by the expectation that vaccinations will begin in the UK next week, in America maybe in the next couple of weeks, Tony.
John, as you guys know, it always comes out of nowhere. People like me are famous for coming on TV and saying, "Oh, I think this is going to cause." It's not predictable. What causes, a real kind of sharp 2-week sell-off, and again, I'm not expecting anything too dramatic, is when it's a news item that you can't predict, and it comes from while folks like us, you guys in the media, and me in the sell side strategy group are saying, okay, the market's due for a pullback. Investors aren't playing it that way because that optimism is so high. We track this thing called the National Association of Active Independent Managers. It looks at active money managers, real money movers that range from small to large, and it's at a level that was the most recent time it was there was around the August peak, right before we had that 10% decline, and again before that about 3 years ago. So optimism is very high among actual investors, which is actually a good thing when you're coming off of a historic low.
Tony, fantastic to catch up. You're always looking well. Tony Dwyer there of Canaccord Genuity.
Okay,
Thank you, sir.
Thank you, guys.
Thomas, the vaccine still in the mix, anchoring expectations. It's the virus against the response to that virus. Did you hear what the CDC director had to say in the last 24 hours? Here's the quote. December, January, February are going to be tough. I actually believe they're going to be the most difficult time in the public health history of this nation.
Yeah, well, it's there, and the CDC is asserting itself, certainly, with the lame duckedness of the Trump administration. It'll be interesting to see the Trump response, Dr. Fauci's response into the new administration. But, John, there's so much more going on here besides these horrific pandemic numbers. Lisa mentioned 3M earlier. They exit 3%. They're down 34% from their 2018 high. 3M is basically a failed industrial operation, up 10% a year for the last 10 years. Clearly, that's not good enough.
And a lot of deal making this week too, Tom. Salesforce, Standard & Poor's. We've done a lot of deals this week already, just in terms of dollar amount, some serious money.
Yeah, serious money. Of course, Emily Chang's wonderful interview was with the Benioff Slack I know we're talking to today.
From London and New York this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures are just a little bit negative by a quarter point, down by 0.01%. Up next, Kathy Jones and Charles Schwab. This is Bloomberg.
With the first word news, I'm Rishka Gupta. House Speaker Nancy Pelosi and Senate Democratic leader Chuck Schumer are now backing a bipartisan stimulus plan. They see the proposal from House and Senate lawmakers as the foundation for a new round of negotiations. The plan calls for $908 billion in spending. That's less than what Democrats want, but an increase from the number being floated by Senate Majority Leader Mitch McConnell. The U.S. has had its deadliest day yet in the pandemic. According to Johns Hopkins University, the number of fatalities went over 2,700 for the first time. Meanwhile, hospitalizations also set a new mark, going over 100,000. California posted a 38% surge in the last week of November. The U.S. has restricted travel visas for millions of members of China's Communist Party. New rules will allow party members and their families to obtain visas good for 1 month. Previously, they could get 10-year visas. The U.S. Embassy in Beijing says China's Communist Party actively tries to influence Americans through propaganda and economic coercion. OPEC and its allies are making progress in talks on oil output cuts. That increases the chances that today's meeting can salvage a deal after failed negotiations earlier this week. One delegate tells Bloomberg discussions are now focusing on proposals for gradual easing of output cuts over several months. And United Parcel Service is trying to keep from being overwhelmed by the holiday rush. UPS is temporarily restricting some packages it takes from big retailers such as Nike, Gap, and LL Bean. The company says it's steering large customers to ship on days when volume isn't as heavy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
There are many sectors that could use some help. I would start with the labor market. I think we ought to remember that despite the rapid progress in getting people back to work, which is so welcome, there's still 10 million people who are out of work because of the pandemic.
Work to do. That's the message from the Federal Reserve Chairman Jerome Powell on Capitol Hill over the last couple of days. From London and New York this morning, good morning to you all. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro, live on Bloomberg TV and radio. Here's the price action this Thursday morning. Speaking of the job market, jobless claims coming in about 1 hour, 12 minutes time. We'll bring that number to you right here on Bloomberg with Michael McKee. Equity futures are going nowhere after another all-time high in the equity market on the S&P 500. In the FX market, some new levels for 2020. Euro dollar, the high of the year, 121.39. Right now, 121.33, up about 0.1%. That is a stronger euro, more broadly a weaker dollar over the last month or so. In the bond market, yields break out this week on what? Well, that's the debate. 0.9261% is where the yield is right now. We come in around about a basis point, but that move gets the attention of many, Tom. So you've got a record high in the equity market, some real dollar weakness for 2020 in the FX market, and a little bit of a breakout in the bond market with yields higher.
Of a bid to the market. Yes, there's some red on the screen with Dow and S&P, but nevertheless, there seems to be a little bit of a lift with that new dollar weakness, euro getting right out, buttressed up against where John mentioned the record high was. Right now, Kevin Cirilli, our chief Washington correspondent, and there's lots to talk about. Lisa and John have some themes. Kevin, I want to go to the Tenure of Office Act, which is really obscure and really ancient 19th century history. The Trump tenure of office reality seems to be playing out in his lame duckedness. Does the Attorney General make it to the White House Christmas party?
Well, if there is going to be a White House Christmas party, but I think from a broader standpoint, the tension that has developed between Attorney General William Barr and President Trump is enough for a short story in a book on history. And I think, quite frankly, it will be as it goes forward, because there's a lot of division right now amongst Republicans, Tom, about where things are going to stand in terms of the presidential pardons, the precedent for the pardons, and the test of the Constitution in terms of where things go, not just in the current administration, but in administrations decades from now.
Who is advising the president? He seems to be colossally alone after a 46-minute video last night. I assume you're the only one at Bloomberg, Kevin, that actually sat through the entire thing. Who is advising the president as he exits the White House?
Rudy Giuliani. And I speak with a source frequently who tells me that Rudy Giuliani is still very much in lockstep with President Trump, and that they have really been, not just from a professional standpoint, but they remain close friends. And it is a close friend of the president's.
Still work to do, Kevin, down on Capitol Hill. Speaker Pelosi has made a move, come all the way in beneath $1 trillion with the bipartisan offer that was put on the table just a couple of days ago. They're coalescing around that now. What's the reception on Capitol Hill to the idea that the Democrats have come in, and markedly so?
Well, not only did they come in, Jonathan, they came in by more than 50% of shaving off the price tag of their $2.3 trillion demands, which of course was a reduction from the $3+ trillion. Now they're at about $900 billion, and that's really music to the ears, not just of Republicans, but also from centrist Democrats, rank and file centrist Democrats, like Congressman Scott Gottheimer, who is the chairman of the Problem Solvers Caucus, a Democrat from New Jersey, who has really been a driving force behind the scenes of this, and he has relationships across the aisle, one of the rare lawmakers to be able to do that. I would also note the handful of Republican senators who publicly have already come out in support of this, people like Senator Susan Collins, a Republican of Maine, who will be a dominant force in the next Congress because she will be the senator in question on many of the bipartisan deals and a swing vote, so to speak, for a Biden administration. There are also Republicans like Senator Richard Shelby, a much more conservative member in the Republican caucus, who haven't yet endorsed this plan, but are saying that they are open to it. And as a result of that, in particular, a lot of folks here inside of the nation's capital are more optimistic, get this, about passing stimulus in the lame duck than they are about passing a Defense Authorization Act in the lame duck.
Wow, that's telling. I will say, Kevin, there still is the sticking point of funding to state and local governments. And that, to me, is the big question, whether Mitch McConnell and actually President Trump would be willing to sign off on the amount of aid that they have included in this bill. What's your read on that?
Well, I think the Republicans that came out yesterday in the Senate who signaled support for this and signaled a green light make me think that right now they're at a yellow light and could be moving to green. It's not red. But that aside, look, the issue of state and local government has been discussed amongst Republicans that I talked to by saying this would be funding for schools. And they're making this pitch now, and again, a dramatic reduction from what Speaker Pelosi had originally asked for by more than 50% reduction. And they're saying that the couple of $100 billion that would go to state and local governments really would be driven towards helping schools.
Kevin, it's a massive reduction. It's great to catch up, sir. Kevin Turulli, Bloomberg Chief, Washington correspondent. Thank you, Kevin. Tom, Speaker Pelosi and Senate Minority Leader Schumer coming all the way in, from north of $2 trillion to south of $1 trillion. That's a big move to get this ball moving.
Well, it's a big move, and it comes in hindsight of, a number of weeks ago, 4, 5, 6 weeks ago, where they blinked and said, no, they needed that bigger number. The reality here, John, and we all know this, and frankly, I give great credit to Mike McKee and our team for leading on the obvious changes in the unemployment of the nation. We make a joke about it, John. I'm sorry. It's all about jobs, whether London, Washington, anywhere else.
Couldn't agree more.
Politics is about jobs.
The reality is that the lockdowns have come back in places like Los Angeles, the stay-at-home orders, maybe not in the same way they were delivered back in spring, but a similar shape, Tom, a similar flavor. And when you start to tell people they've got to stay at home, you've got to provide the aid. Otherwise, where's the compliance going to be?
Okay,
Who wants to comply with a stay-at-home order if you can't get paid, if you can't work,
John,
if you can't pay the bills?
You're right. It's the European and the American difference. And let's be clear here. There's a large body of Americans that agree with the deficit hawks that they don't want to provide income substitution or income replacement. We're hearing from on-the-ground politicians. They aggressively disagree with that. You heard it from Chairman Powell. I've never heard a Fed chairman speak like that, ever.
I think you've got to recognize, though, Tom, and Lisa, please weigh in on this, that the conversation has changed, that what we used to consider a deficit hawk means something completely different now. A deficit hawk in Washington is someone who wants a $500 billion package and not a $2 trillion package. That's what a deficit hawk in D.C. is now.
Yeah, nobody's really that worried about the debt, even people who are supposedly worried about the debt. One thing I find fascinating is that the shift in tone from the Democrats seems to come on the heels of a shift in tone, but Republicans as well, looking out to 2021 and an additional funding package that will be passed by Biden. So this looks like more of a down payment, which is also a shift, John.
Sure. I think it's a recognition we've got to get to March.
Yeah.
Got to get through December, January, February. The vaccinations will start to pick up. We all welcome that, but you've got to get through to March. Doesn't that remind us of earlier this year where you've got to get through to the end of spring then summer,
the bridge
to fall. From London and New York this morning, good morning.
Poetic, he sounds
This
like Lord
is
Byron.
Bloomberg. There is something really uncomfortable about this equity market worldwide. Record highs at a time like this. Maybe you're comfortable with that. I feel uncomfortable. A record high in the S&P, a record high in the NASDAQ. We had some weight to that on big tech, up another 0.2%. We pulled back just a little bit on the S&P 500. Let's whip through the bond market. Yields up. Maybe some people welcoming that move, helping to reinforce that rotation in the equity market. Yields higher to about 93 basis points on a 10-year. We break out towards 170 on a 30-year. Steeper curve. Kathy Jones and Charles Schwab joining us in just a moment to weigh in on what's behind this so far this week. I won't spend too much time on that. I'll spend a little bit of time on this. Switch up the board. In foreign exchange, the story for me, the euro strength. There has been 3 phases to this euro move off the back of spring. One was off the back of the Fed, inducing some dollar weakness, euro up, euro stronger. The next move was the important one. It was the trade-weighted euro move. It was off the back of that deal, that the Brussels deal that the leaders came together with. That euro move was trade-weighted. That made the ECB uncomfortable. The euro, too strong. That went through to August. Next move is more recent. That's a dollar weakness move. Until recently, in the last week, this is what I want to look at, not just euro dollar, euro China, euro sterling. We're starting to see that euro strength, Tom, become a little bit more broad-based, and I think that's really, really important. The last month or so, it's been a dollar weakness story. Over the last couple of days, it's been more broadly a euro strength story.
Right.
If you start to see echoes of the middle of this year, where it's a trade-weighted euro strength story, that's when the pressure starts to build on the ECB, and they meet a week today.
Well, let's brief global Wall Street on this right now. George Saravelis of Deutsche Bank with us earlier this morning. I want to frame this out, folks. You've got euro, as John mentions, 119 up to a 121 stronger euro. Mr. Saravelis puts purchasing power parity for euro at about a 125. That's a squishy number. His call is for 130 euro. He and I collegially disagreed on what would be the effect of that on the nations. He said there'd be minimal effect, more ECB focused. I just don't buy it. I'm more of a traditionalist back to the 1980s, where I'd really suggest at some point here along the path from 121 out to 124.68 and on to Saravelis's 130, you're going to see some real angst in Europe. So that's a foreign exchange dynamic right now. Right now, the bond dynamic, as John mentioned, Kathleen Jones joins us right now with Schwab and their Center for Financial Research. Kathy Jones, we're seeing a bond move. I see the Bloomberg Barclays Total Return Index up, up, up. It doesn't compare to the equity markets, but still, it's been an extraordinary 2-year run for bonds. When do bonds breathe and we see price down and yield up?
I think we're starting to see it, particularly in the long end now. You know, we've seen the steepening of the curve with a 10-year Treasury pushing up against that 1%. And we're looking for further steepening, that bearish steepening where the Fed has anchored short-term rates near zero and long-term rates try to edge higher. Not looking for a huge move at this stage of the game because the economy still has a pretty dark period to go through here. But I think as we look into the second half of next year, if we really get the vaccines distributed and the economy fully reopens, people get back to work, it's not unlikely that 10-year yields are in that 1 to 1.5% area.
There's a consensus in markets that bond yields would be much higher if it weren't for the widespread belief that the Fed will step in and suppress yields if they climb too high. What is that level that triggers the Fed's concern?
Yeah, I wish I knew. I wish there was like a line in the sand that they're going to draw, but I don't think that that's realistic. I think it's more likely that the Fed looks at the rate of change and the underlying nature of what's driving it. So if you're sitting at the Fed and you see rates move up to 1.25, and it's off the back of good economic data, falling unemployment, rising consumption, you might just shrug your shoulders and say, that's not a terrible thing. If it's disorderly and a sudden jump because inflation expectations have really become unmoored, then it might be an area to worry about. But at this stage of the game, financial conditions are really easy, and even with a quarter-point move from here, they'd still probably be pretty easy.
Kathy, expectations matter, though, and you and I know a ton of people who believe that yields won't go much higher because the Fed will step in December 16th and extend the average maturity of their bond buying. I'm wondering if they don't, how big the air pocket is for treasuries.
Yeah, there does seem to be a widespread consensus about that. I'm not really sure why. When I read the minutes of the last meeting, I don't get the sense that they're eager to jump in at this stage of the game or to extend duration. So maybe that does give us a bit of a pop here. But the realistic situation is we still have a lot of bad news to get through over the next quarter or so. And I think that in and of itself will probably limit the appreciation in terms of yields from here.
So it's interesting to me, Kathy, that the disruption of the next few months would keep a lid on Treasury yields, but it won't keep a floor on how tight credit spreads can go. Credit keeps rallying, but yields are limited on Treasuries. Square that for me, Kathy. Make sense of that for me. If it matters for Treasuries, why doesn't it matter for credit?
Yeah, I think credit spreads are about as tight as they can go for the time being, particularly in high yield. Maybe they can extend a bit further. You know, the market, certainly high yield and much of the world of credit is much more like the stock market than the treasury market. And so they're looking forward at earnings coming back and cash flows improving. The search for yield, that's all driving this sort of cyclical rally in credit. And I think it continues over the next 6 months to a year or so, but a lot of it's been done already, and the lower credit quality is certainly vulnerable to some sort of bad news here because, particularly in the high yield world, the lowest rated bonds, the triple Cs, et cetera, have rallied so much, there's not much in the way of reward left for the risk.
Kathy, what are people actually doing with their money now? Schwab has a wonderful ability to see not what we say, not what we talk, but what we do. What are we doing when you look at bond, bill, and note flows?
Yeah, we see a lot of our clients sticking with shorter duration, higher quality bonds. They like munis. We have a pretty large cohort of retirees or people near retirement, and they're still committed to their municipal bonds, bond ladders. They really haven't changed the way they look at things, but shortening duration, keeping duration short, waiting for yields to move up seems to be the major trend amongst the bond investors.
So I want to go to something that John was talking about earlier when he started this segment and was looking at the equity market and said, this doesn't feel comfortable. And I'm looking at credit markets, and I'm looking at triple C of bond yields. Basically, these are the bonds that are the riskiest of risky. They're the closest to default. And yields on this debt are the lowest since 2014. I'm also looking at the fact that you have companies burning through cash, an increasing number, before they even pay interest and other expenses. At what point is this unsustainable? In other words, how long do they have before we have to get that vaccine or something to end the pandemic for them to stay in business?
Yeah, and this is the worrisome part about high yield, the real risk. That cash burn is really picking up and the leverage is very high. And so they need to get things to improve pretty quickly, I would say. If we don't get real light at the end of the tunnel in the first quarter or so, we're going to see those bankruptcies pick up and those defaults increase. And what we're worried about in the default side is the recovery rates are going to be quite low. And that's why we're really pretty cautious about the high yield market.
Kathy, who's going to bear the brunt of those losses?
Oh, gosh. It's going to be probably spread out pretty well. We have a pretty wide swath of people who have been in the ETFs. So if you're in a broad-based high yield ETF, there's defaults and losses. You're going to feel it in any index following investment, but also some of the specialized funds. The active managers always like to tell you that they know which are the good bonds and which are not. So we'll see how well they do.
Really?
But
shade.
Any of the creditors, going to feel the. I'm just reflecting what I'm told. That's all.
I hear the same thing, Kathy. They always hold the good bonds. They never hold the bad
Only
bonds.
the good
Kathy,
ones.
thank you.
Only the good ones.
Kathy Jones of Charles Schwab, the Center for Financial Research. On this program 24 hours ago, we've just had two fantastic fixed income guests, by the way. It was Greg Peters of PGIM yesterday, Kathy Jones of Charles Schwab this morning with us. And Tom, what Greg Peters of PGIM said, and I think got lost in the conversation a little bit, was something on triple C debt, the junkiest of junk. This is bottom of the pile stuff. Spreads now are tighter than they were before the pandemic. Just get your mind around that. Visualize it. Spreads now on the junkiest of junk are tighter than they were before the pandemic. That, Tom, is unreal.
It is different than 2006, but not by much, John. It's a different model, but everybody's searching for what? The 10th, the 100th of a basis point, splitting hairs to get the better yield return. And what it amounts to is it's money that typically by prospectus can't go to equities, and it's got to find a place to go. I go back to Sir John Templeton 1,000,000 years ago. He told me there will be a shortage of bonds. That's where we are right now.
Lisa, your thoughts, triple C's, where they are right now?
Well, if you look at spreads, they're tighter than they were earlier this year. If you look at all-in yields, all-in borrowing costs, it's the lowest going back to 2014. I find this really interesting coming at a time that Bloomberg News put out an article this morning talking that nearly 50 companies out of a universe of 600 are now burning through cash before they even pay their baseline expenses. We're talking about Carnival and other travel companies that are in the lower rated ranks of corporate America. I am wondering at what point this is unsustainable, John. At what point will lenders say, we don't want to lend to a company when we don't know how long this bridge is, because we still don't know.
It's an amazing chart and a phenomenal year. Many times this year I've just felt so uncomfortable with where this market is, and Tom, just feel that way again this morning.
I'd say you're on,
all-time high.
You know, all I can say is Farrell, folks, is on the edge of Abramowitz gloom.
Yeah, I've noticed that.
You know, I don't know what to say. You know, what I'd say is, and this is important, Ben Laidler in his morning note, and I'm going to bring in Charles Cantor of Neuberger Berman here, two unabashed bulls, John, and they just see a growth recovery into 2021 with emotion along the way. And the bulls are pricing out away from what you're talking about, Lisa's talking about, pricing away to optimism.
Look, before I get called Mr. Abramowitz anytime soon, I should point out that I think it's great news we have a vaccination program ready to go for 2021. I think that's going to be phenomenal for society. Where the market is at relative to the economy are two completely different stories for 2020. Who's to say they won't be for 2021 as well? Coming up, Dr. Albert Cope of the Yale School of Medicine from London and New York this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Trump is expected to sign a bill that could lead to Chinese companies getting kicked off American stock exchanges. The measure, approved by Congress, calls for U.S. regulators to review the company's financial results. Chinese firms will have at least 3 years to comply. It may be President Trump's last chance to shape the Fed. The Senate is expected today to confirm the nomination of Christopher Waller to serve on the Federal Reserve Board. Waller has been the research director at the St. Louis Fed. In Germany, Chancellor Angela Merkel says the partial lockdown will be extended by 3 weeks. Bars, gyms, and movie theaters will now remain closed until January the 10th. And then government leaders will meet to reassess. The partial lockdown hasn't slowed the coronavirus spread in Germany. And France is putting pressure on European Union negotiators not to make any more trade concessions to the UK. The French are warning they could veto a Brexit deal between the EU and the UK if they don't like the terms. Negotiators are trying to reach an agreement in the next few days. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures
because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Going into next year, including the 50 million from this year, we anticipate 1.3 billion in total. I don't think we've disclosed what we're going to be providing in the first half, but what I can say is, of course, we're ramping up production extremely quickly.
Sean Merritt there of BioNTech, the Chief Commercial Officer from London and New York this morning. Good morning. Alongside Tom Keane and Lisa Abravitz, I'm Jonathan Ferro. Here's the price action this Thursday morning. Let me whip through things pretty quickly for you. Equities all-time highs at a close on Wednesday. We add 2 points to that on the S&P 500. The euro, new high for 2020. Kit Duke's coming up in about 40 minutes' time. We'll talk about it. Euro dollar 121.45, up 0.25%. And yields with a lift through the week, 0.9393 on a US 10-year. A week out from the ECB, add an extra week, and you'll get to the Fed. Two big meetings coming up in the month of December.
A nice flip, John. We've got, from red and green on the screen now to all green, with SPX up a point and Dow up 21 points as well. So the changing, lift to the market this morning. Right now, Albert Koh joins us with Yale, their School of Medicine. He's department chair in epidemiology that barely describes his work, particularly on more interesting bacteria and viruses of Africa. And he joins us this morning on where we are in this pandemic. Dr. Koh, you know from your work at MIT long ago and far away that pandemics are described by the movement and dynamics of differential equations. We've got the movement now of cases, the movement of hospitalizations, the movement of deaths, which is tragic this morning. Which should we focus on as we try to gauge and understand this pandemic?
Well, Tom, thank you very much for having me back again, and it's a real pleasure. So, as you referred to, transmission dynamics of infectious disease follow certain mathematical principles, and one of those is exponential growth. That one person infects two infects four. So of those three things that you mentioned, both cases, hospitalizations, and also intensive care units and what's happening there, all three of those are important. Hospitalizations, intensive care units tell us how bad our hospitals are suffering now. Cases will tell us, the growth in cases now will tell us how bad we're going to be in about 3 or 4 weeks in terms of hospitalizations, intensive care. So this is all very concerning what's happening at the moment.
If we look at the vectors here, and I'm not going to go into the fancy math because of time here, but Dr. Koh, there are major steepness in the United Kingdom, major reversion in New York City to trends seen in April or May. What have you learned about this pandemic that can help us change and bend those vectors?
Yeah, so we've learned a lot about what can be done to effectively, either what was called flattening the curve or even getting ahead of the curve in preventing, resurgences. The first, face mask, social distancing, decreasing super spreading events by limiting gathering sizes. Those things work better when done proactively than reactively. We're already in the middle of the surge. So we have to, in order to bend that curve down, we're going to have, those interventions need to be implemented now, and we will only see their impact 3 or 4 weeks from now.
Doctor, if you manage to target the vaccinations towards the most at-risk in society, can you pull back these restrictions before you reach or get anywhere near herd immunity?
Yes. So I think, well, first of all, I think, John, that's an important question. I think we have to understand that, the first groups that are going to be prioritized are groups that are vulnerable with respect to their role in society, like high school workers, and the others that are vulnerable to getting severe complications and poor outcomes from the virus. And those are particularly the nursing home, the elderly and nursing home residents, and the people who work with nursing home residents, such as the staff. The herd immunity is, it's going to, right now, we're only a small fraction of Americans in the U.S. have been infected with the virus. We're not going to be reaching herd immunity, where 60-70% of the population is infected by the time the vaccine comes. So the vaccine is going to be really important in rolling that out quickly. It's going to be important in terms of building immunity and controlling transmission in the long run.
Dr. Koh, to build on John's point here, we're looking right now at a lockdown, stay-at-home order in Los Angeles. We're looking at exponential figures in a number of spots throughout the nation when you look at the virus counts. At this point, is there anything other than rolling lockdowns or stay-at-home orders that could potentially control this a little bit more before we get to that herd immunity, which is months away still?
Right, yeah, and so there's a long road to getting vaccines implemented, at the population level where we're going to be able to see effects in prevention. And I would guess those are going to be, 6 months from now, if not longer. So what needs to be done and what needs to be done now? It really goes back to the basics. The use of face masks, to preventing spread and transmission, decreasing super spreading events, and that's, whether limiting, gathering sizes, and, ultimately, it's those targeted measures, whether it's targeted closures of restaurants, places where people are gathering and transmission is occurring, then it's ultimately stay home, stay safe orders and lockdown. And as you see, Europe has already done this. Many places in the United States may need to do this in order to control this surge.
An important conversation. Doctor, always great to catch up with you, sir. Come back soon. Dr. Albert Koh there of the Yale School of Medicine. An important conversation, Tom, because a lot of people are talking about the need to get to herd immunity before we can get anywhere near back to what people might perceive to be normal. If you can address this vaccine and target it very specifically at the most at-risk in society, you can really do something about, and I hate having this conversation, it really is so sobering, you can do a lot about the death rate and some of the percentages there, because the most at risk obviously skew that number, Tom. So it's not about getting to herd immunity before you pull back the restrictions. It's about vaccinating the most at risk in society before you can pull things back.
You're absolutely dead on about that. That was a debate in a number of our conversations yesterday, John. But I really want to point out here, I have yet to hear a single pro talk constructively about herd immunity. Not one single pro. And the issue is one single part of the equation, which is the virulence of this virus. And the thing is, it's a strong, deadly virus. This isn't the flu. It's not the common cold. And herd immunity dynamics and mathematics simply doesn't work.
Coming up on this program, on the markets, Daniel Morris, BNP Paribas Asset Management Chief Market Strategist, on the record highs that we see on the S&P 500 and on the Nasdaq as well, as we count you down to an ECB decision a week today with the euro dollar at the highs for 2020 and some real dollar weakness starting to come through this market in the last couple of weeks. There's the board, euro dollar 120.144, equity futures up around about 2 points. And in the bond market, there's your move, 0.941% is your yield on a US 10-year. For our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
is desperate for yield. The world is desperate for income. With vaccines in sight, there is much hope.
Entrepreneurial America will come back.
There's pent-up demand for getting out of the house.
There's an enormous amount of stimulus that has yet to be spent.
Even though 2021 is supposed to be a good year, you may start off in a deep hole.
By the end of this month, the market will be very overbought. The breadth will start to narrow.
Certainly some support is going to be needed going forward.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us. The simulcast, Bloomberg Radio, coast to coast and worldwide. Good morning on Bloomberg Television. A chillier New York City. Christmas tree lighting tonight at Rockefeller Center as well. And all the worry out there, as we've talked about in the last hour, the worry of this pandemic. Deaths at a record level in the United States, breaking the April 29 level as well. And John, the markets speak moments ago, euro out to new recent record strengths.
A record high in the equity market, the unwelcome record in the pandemic, and the euro dollar highs for 2020, 121.53. Another breakout this morning. Once again, it's broad-based dollar weakness. You just wonder how uncomfortable this dollar move will make the ECB a week today at their next ECB meeting, and how comfortable the move in euro China over the last few months will actually keep them, Tom. I think that's key. What happens broad-based for the euro against other crosses, sterling, China, yuan, and what happens against the dollar too.
Levels reset here. I'm looking at the Bloomberg terminal here. You can see that on Bloomberg Radio right now. And renminbi comes down as well with an abrupt move of renminbi strength. Lisa, it all correlates in together. And then there's the zombiness, the gloom of the bond market. How do you correlate this in to what we see in fixed income?
Well, zombiness is expressed by actually incredible enthusiasm to buy credit even at very high valuations. Look, when you talk about my gloominess, I want to paint a picture for you. The markets are not the economy. You've got M&A going gangbusters. You've got job cuts, which we got this morning from 3M, more of those. What we have is the big getting bigger and cost cutting across the board, which hurts the lower income worker, which hurts certain aspects of the economy. So again, I'm looking at this and I'm wondering structurally, what aspects are going to have a scarring impact down the line that may not be felt in markets? So that's where my gloom is coming from, Tom. I just wanted to clarify that.
Well, we will see here. You wonder where we're going in terms of the stimulus debate, but certainly markets on the move, red and green. We saw earlier in equity markets, and now we see it with the green on the screen lift. Futures up one, Dow futures up just 2 points as well. NASDAQ 100 leading the way as well. John, one more observation, and I've really got to go to the landscape of the United Kingdom. I noticed that per capita, the United Kingdom deaths right now exceed New York City at its worst back in April and May. There's a real agony over in the United Kingdom. Is it an agony of complete lockdown? Is that where you're heading?
Restrictions. We're sticking with a tiering system, and that's the truth of things as they stand. And I think this is the holding pattern for the vaccination period all the way through to spring. The Prime Minister said that himself. You have tier 3, very severe, looks like a lockdown. Tier 2, a little bit lighter. Tier 1 feels a little bit normal. London is in tier 2, and this will be the system, the holding pattern that this government keeps through the winter and into spring. Even with the vaccinations rolling out, there is a real worry in the UK government, I imagine it's shared by others too, that just because we have a vaccination, that maybe some people will start to step back from compliance with social distancing and those kind of things, Tom. It's something that officials are worried about as the vaccinations begin in the UK, potentially as soon as next week.
I'll stay with us through the morning, and we'll have more conversations, of course, driving forward the conversation on this pandemic. Right now, an important conversation. Have we spoken to other bulls? Ben Laidler of Tower Hudson, Charles Cantor with us earlier of Neuberger Berman. Daniel Morris has been at BNP Paribas, and they've constructed an interesting outlook on the market. Daniel Morris, you look for growth into 2021. Frame the equity market at these record levels.
Well, I think it's as much looking at what's happening beneath the kind of index level and looking at the rotation that we're seeing between growth and value. So, yes, equity markets are at record levels. Nonetheless, we are coming out of a recession. The economy should be bigger in nominal terms at the end of next year than it is now. So that really suggests that the stock market should continue to rise and essentially continue to reach new highs. So that for us isn't particularly surprising or worrisome.
we're paying more attention to where we want to be allocated within that market, because we think there certainly are going to be bigger divergences between different sectors, between styles, between countries than necessarily we have had in previous years.
Dan, we're pricing 21. When do we start pricing 22?
Well, I think what maybe will start to perhaps impinge on the market at that point is you would think about, is there any potential for more significant legislative change? I mean, right now we're all going to be focused on, are we going to get a stimulus package and how big will it be and so on. When you get into the second year, it's going to be, you will at that point have had still a relatively young recovery, so I think there still should be some gas in the tank at that point. The marginal change at that point, who knows,
Right.
It might be another fear of inflation, but at this point we don't see any big risks on the horizon.
And Lisa, we know John's question is said with respect. We heard that from David Kostin of Goldman Sachs yesterday. His courage to really get out and guesstimate 2022.
Well, and it's important because the future is what predicts the current gains in the stock market. It is a forward-looking indicator, so we got to keep looking forward to see what begets what. Dan, I'm looking right now at markets where the big have gotten bigger and the big have gotten rewarded for getting bigger. Now we're trying to see the small caps rally and catch up. At what point is this divergence too much to handle? In other words, can the big keep doing well and allow the small ones to catch up, or is this a fundamental divergence in the economy as it is right now?
Well, you're right to focus in on the kind of the dominance of the big players driving that difference in the relative return of small cap, which has been quite disappointing in the U.S. for a couple of years. What's notable is if you look at small cap performance relative to large cap in Europe, small cap has done quite well, continues to do well in the way that you kind of assume small cap should. You know, we kind of have this bias that over the long run we see small cap outperformance. That hasn't been the case for several periods in the U.S. And if you analyze why that was, it really does come down to the big mega cap techs, that their dominance in the large cap indices made it almost impossible for the small cap stocks to outperform. So at this point, given our expectation for continued rotation into value, you're right, that should give a bit of a breather to small caps. And we also think this is where you need to be looking at, you know, stock picking as opposed to necessarily index asset allocation, because otherwise you are likely to be swamped in the future again by the dominance of the big techs, and you can miss out of the potential that we still think is there in small caps.
Do you want to be swamped by the dominance of big banks in Europe if you buy the index, Dan?
Well, I think well, so much the dilemma. Certainly, what you've seen recently with an increase in interest rates. I mean, we don't want to forget that at the same time, you've had about a 25 basis point swing in 10-year Treasury yields. You've had that much in the UK and almost as much in other parts of Europe. So certainly, that's fed through and benefited the financial sector. At the same time, basically with this better than expected economic outlook, whatever estimates you had for non-performing loans, those should come down. So that's clearly beneficial for a bank balance sheet. So for now, at least the news is better. We've had a lot of bad news for financials for a long time. The market's focusing on that, and we think that also can continue for a bit.
Daniel Morris, all of this comes down to a belief, and we're shell-shocked here by the pandemic and the rest of it. As you mentioned at the beginning of this conversation, a belief in a better nominal GDP. Is this market priced for the nominal GDP now, or is it priced for some wish that's out there 1 year, 2 years, or 3 years out?
We don't think so. If you actually look at forward earnings estimates, even 2 years out, relative to where they were pre-pandemic, it's not like the analysts are predicting, you know, in absolute terms, 10%, 20% earnings growth relative to those levels. They're actually still below the levels that you would have thought or people did think at the end of 2019. So the trajectory is positive. The slope of the line is positive. So that's what the markets are thinking about. But at the same time, that terminal point, or at least the point 2 years out, isn't excessive in our view. So we don't think expectations are out of line. We think there is going to continue to be a recovery, and it's that marginal change that matters the most.
Daniel, you also talked about the importance of where you allocate your money. Where are you allocating your money? Are you jumping on the emerging markets train?
We are overweight emerging markets, so we've reduced that overweight a bit and added to Japan. So overall overweight EM. Within developed markets, it's U.S. and Japan, frankly, though with a preference, like I said, for value and also for small cap. So we think there are certain parts of the market that are going to do better than others, absolutely.
Dan, just quickly, a final one from me. When everyone starts saying the same thing, when do you start to feel like this is priced?
Yeah, I think that's certainly what's in the back of my mind. You know, this view that we all face, that we face short-term challenges, but the medium-term outlook is rosy. I think you see that reflected in, one, the consensus view also that the dollar is going to continue to weaken, which, for what it's worth, is also our view. You know, that's when we do need to ask ourselves what's going to challenge that view that is so widely shared. What are going to be the impacts? So it's the right question, and it's one we're certainly asking ourselves.
I'll keep asking it too. Dan, it's great to catch up, sir. Dan Morris of BNP Paribas Asset Management. Tom, we keep hearing the same thing. At what point do you sit around a table, over Zoom or whatever, and start saying everyone is saying the same thing? Doesn't mean it's wrong. I just wonder where the edge is going to be in the next 12 months. Is everyone is overweight EM, small caps, value over growth, cyclicals over defensive, a weaker dollar, treasury yields limited in their little breakout. That's been a story repeatedly over the last few weeks.
You have just defined, John, a bull market where there's a rationalization each step of the way. Frankly, bear markets are no different. Their slope on a log normal basis is a lot stranger, a lot more rapid. But in the heart of a major bull market, this is what you get into. John, the one thing I would say that's underestimated here is corporations will adapt and adjust to the facts they're handed. And that's what we're seeing. And again, you see that with 3M cost reductions today of 3% of employment. That's been widely anticipated. What took so long? There are going to be many more 3M-like announcements to keep earnings where they are and margins.
As many people would respond, Tom, that's not the kind of decision that you make when we are at the top. That's what a lot of people would say. You don't make job cuts at the top, you make them at the bottom. So maybe, as you say, this is the start of something explosive. I don't know. It's a strange time. From London and New York this morning, good morning to you all. Euro, dollar, 121.50.
Wow.
Kit Jukes, the sock gen at the bottom of the hour. Looking forward to that. From London and New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Speaker Nancy Pelosi and Senate Democratic leader Chuck Schumer are now backing a bipartisan stimulus plan. They see the proposal from House and Senate lawmakers as the foundation for a new round of negotiations. The plan calls for $908 billion in spending. That's less than what Democrats want, but an increase from the number being floated by Senate Majority Leader Mitch McConnell. The U.S. has had its deadliest day yet in the pandemic. According to Johns Hopkins University, the number of fatalities went over 2,700 for the first time. Meanwhile, hospitalizations also set a new mark, going over 100,000. California posted a 38% surge in the last week of November. And the U.S. has restricted travel visas for millions of members of China's Communist Party. New rules will allow party members and their families to obtain visas good for 1 month. Previously, they could get 10-year visas. The U.S. Embassy in Beijing says China's Communist Party actively tries to influence Americans through propaganda and economic coercion. And OPEC and its allies are making progress in talks on oil output cuts. That increases the chances that today's meeting can salvage a deal after failed negotiations earlier this week. One delegate tells Bloomberg discussions are now focusing on proposals for gradual easing of output cuts over several months. And United Parcel Service is trying to keep from being overwhelmed by the holiday rush. UPS is temporarily restricting some packages it takes from big retailers such as Nike, Gap, and LL Bean. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
China will not stop if we step back from working with the world. If the rules of the future are written or suspended because of the way that relationship evolves, America will be stronger, not weaker.
A key topic going into a new administration and a new year. That was Jacob Lew, the former U.S. Treasury Secretary, speaking live on Bloomberg TV and radio for our audience worldwide. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. And here's the price action as we count you down to jobless claims, 12 minutes away. Equity markets, all-time highs. Highs of the year on the S&P 500. Highs of the year on euro-dollar. Euro-dollar 121.47 right now. New high for the year is 121.61. The lows of the year, 1.0636 on March 23rd. So the highs correspond with the highs in the market and the lows correspond with the lows of the market. It's been a very elegant relationship through the year. The dollar story, the equity story. In a bond market, unchanged on 10, 0.936%, unchanged after a deep sell-off over the last couple of days and going into more economic data. 10 minutes away, Tom.
Well, 10 minutes away, and we'll have it for you. Michael McKee, of course, and it's a very different claims report after some of the criticisms on the data in the last number of days. We'll dive into that. Jobs Day tomorrow. Right now, we want to digress. Daniel Tannenbaum with us, with Oliver Wyman. What we love to do on the show, on radio, on TV, is give you people that own the domain they live in. That would be Mr. Tannenbaum on financial crime, Mr. Tannenbaum on sanctions and Americans' relations with the financial world. He is a partner at Oliver Wyman. Dan Tannenbaum, good morning. I know John and Lisa want to migrate to China, as we heard from Jack Lew moments ago. I've got to ask you about an assassination in Iran. I mean, this is serious stuff, and the Biden administration comes into an Iran-U.S. relationship that is not Trump-Iran or, frankly, Obama-Iran. What will that relationship look like?
Thanks, Tom. It is important to note that while the Biden administration is clearly preparing to take office in January, that we still have 49 days of a Trump administration and Trump-related allies acting around the world. I think you're certainly seeing actors trying to box in the U.S. from attempting to jumpstart the Iran deal, although I think that there is something that people tend to forget, is that Iran needs to agree to re-enter the deal, given that they derived no benefit out of the last one. So it is creating complexities in the region with some of the attacks. There's been a handful in the last couple of weeks of Iranian government officials and military officials that have been assassinated which only further creates distance between the JCPOA, Iran, and the other allies that are a party to the deal.
I look, Dan, I'm distracted here just looking at the news flow right now. And I think just because of the news, we have to migrate to China, although there's so much to talk about. What can we do in your area financially on Hong Kong? Should we expect or demand that Bank of America, JP Morgan, and the others do some action on liberties in Hong Kong?
So if you look at what the U.S. has done with Hong Kong under the Hong Kong Autonomy Act that was passed over the summer, many global banks in the market, even those operating in mainland China, have closed the accounts of people like Carrie Lam and others in the government. There was an article over the weekend of how Carrie Lam is paid in cash because she can't access her bank account, she can't access her credit cards, and so everything is in Hong Kong dollars. You know, Hong Kong has one legitimate trump card left, no pun intended, within the next 49 days. And one of the other caveats to the Hong Kong sanctions, where that by October of 2021, the U.S. government had to designate banks found to be enabling the enactment of the national security law in Hong Kong. So you have a possibility that some Chinese banks could end up being designated for continuing to provide banking services to some of these people like Carrie Lam and others. And that obviously would drive an even bigger wedge between the U.S.-China dynamic right now.
They've got to pick a side, but Dan, this brings up something so important. We've been talking about the FX market all morning and about dollar weakness and cyclical issues. This is a structural issue. I won't name names, but there's many people who think we're about to see the end of the US dollar as the dominant world currency. What this underlines is just how powerful, Dan, the US dollar still is. Just think about that. You said it, I'll repeat it. Carrie Lam, the leader of Hong Kong, can't get a bank account. Carrie Lam has to be paid in cash. Dan, can you speak to that, the power still of the US dollar?
Yeah, and I think initially, if you saw what the U.S. did with Hong Kong, originally the Hong Kong Monetary Authority, which governs obviously the banks in the territory, came out saying you cannot comply with U.S. sanctions on Hong Kong in Hong Kong, only to backpedal a few months later where the MA came out saying, you know, actually, we're okay if you need to comply. There's never been a conflict of law issue like this. There's been EU anti-boycotts on restrictions against Cuba from the U.S., but a U.S.-China issue is different. Then again, we've heard threats over the years, I mean, dating back to when I was at Treasury in 2007, that the dollar was going to end as the global trade currency related to EU and Iran activity, and it's never quite happened. I'm not quite sure how this will shake out, but I mean, I think certainly the U.S. dollar and the need to trade and transact in the dollar drives a lot of the actions by these global banks until China ups the ante from their side, which they really haven't done. They've been fairly measured in their response to date.
And I will just point out that John's point comes as the yuan strengthens to the strongest since June 2018 versus the dollar. So in terms of the dominance here, which raises a question of when China steps in, when the PBOC steps in and starts to take note of the strength of its currency and take action.
Well, and there's another variable that needs to be brought up in this dynamic as well. Just yesterday, the House passed a bill that the Senate had passed before that would require Chinese-based companies on U.S.-listed exchanges to comply with U.S. audit standards, something that they've fought for years. So you have another issue potentially that could drive a further wedge between U.S. and China.
Dan, I've got to jump in because we only have a minute left. I've got to jump in, forgive me. Why did this take so long? Why were these companies ever allowed to list on U.S. exchanges without adhering to U.S. auditing rules? Why did this take so long?
I think the political nature of how to engage with certain Chinese companies, knowing what the Chinese government's view is on essentially opening the books to foreign auditors in their domestic companies has always been a challenge. I think all of the China pressure, whether it was related to the Uyghur treatment in Xinjiang, Hong Kong, other sorts of human rights abuses, plus the national security threats really boiled over with the House and Senate now passing this legislation.
Dan, forgive me for rushing you. It's great to catch up, as always. We enjoy having you on the programme. Dan Tannenbaum there, of Oliver Wyman, a partner. Tom, I think that conversation underlines something so important. Whenever we talk about the US dollar, the FX market, we're talking about cyclical issues, rate differentials, the fundamentals, the economy, monetary policy. It's a different argument to say that just because the dollar is weakening, it's somehow losing its dominance in the global economy. That's a completely different conversation.
Well, it's a completely different conversation, John. I've heard it since before I could shave once. I'm only shaving twice a week now, but John, that conversation has been out there forever. These are ebbs and flows in the market. Yeah, there's dollar weakness, but compared to the 80s, it's nothing. John, you should watch The Crown. Your grandfather's in it.
I would love to watch The Crown. Coming up, Kit Jukes.
Retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance live on Bloomberg TV and radio for our audience worldwide. We've got some data for you, which means Michael McKee joins us this morning to break it down. Mike, jobless claims, they've been weak the last couple of weeks. What have we got now?
Well, we are waiting for those numbers to come out, John, and it's all a little bit slower these days because the everything comes out on the internet, but right now where we are is 712,000, which is a significant change, much lower than the last week, which was initially reported at 778. We're waiting for the numbers to pop up in terms of the revisions. Continuing claims are at 5,520,000. That's down from 6,071,000, or there's the revision, 6,089,000. So a significant drop of about 500,000 there. And initial jobless claims the prior week, 787. So big drop of about 12. We'll call it 70,000 jobless claims, which is a bit of a surprise. Now, I got to mention this, and we talked about it yesterday on your show, John. The problem we have this year is the fact that the numbers are so large, they don't seem to be accurate anymore. The Government Accountability Office put out a study this week that said, quote, the number of claims has not been an accurate estimate of the number of individuals claiming benefits during the pandemic because of backlogs in processing a historic volume of claims, among other data issues. So what they're saying is these numbers are too high, and we should see something much smaller. And
right.
It's still a lot of people out of work, still a big problem as we come into the end of the year and all those assistance programs end, but we can't really take the numbers too seriously as actual numbers.
Okay, but Mike, this is important, and I don't mean the jobless claims. I mean the fact you're on Pharaoh's property yesterday and not on our property. We are jealous of our Michael McKee time. Michael, what's the real number? I mean, what's the McKee adjusted claim statistic?
Well, I spent a lot of time working on this, and I'll tell you, Tom, it's I don't have any idea. The GAO did not say that they had a precise figure. They just say there's so much duplication in the numbers. There's a lot of fraud, and there's so many back applications that haven't been finished yet that they don't really know. They know it's high, but they don't think it's probably 712,000.
All right, Mike, so then do these numbers matter? I mean, can we rely on them for anything?
You can rely on the fact that they are large, and it will factor into thinking in Washington about the fiscal cliff that comes December 31st. I mean, you got, according to these numbers, and even if they're wrong, as of November 14th, in the middle of last month, there were 20 million people who were still getting benefits of some sort. Have that, and you've got 10 million, and that's still a lot of people who will fall off the rolls if they don't get an extension to their benefits.
Michael McKee, thanks so much on the jobs report. Just fascinating, the number trend here. It used to be easy. You look at the 4-week moving average and move on. I guess we can't do that anymore. We'll have much more on this. And, of course, Michael McKee tomorrow on Jobs Day. Really important here, this first look at the November data. Right now, we've been talking about this all morning. Perfect timing to speak to Kit Jutes, Societe Generale. Yes, on foreign exchange, but he wonderfully folds it into the political economies of the world's financial system. Kit Jutes, let me start with the why. Why is the euro appreciating?
I think the euro is appreciating because the dollar's falling, simple starting point, because the real interest rate advantage that the dollar built up against the euro since 2011 has collapsed. And as the global economy starts to look forwards at a better tomorrow with vaccines, we can't have the euro this undervalued against the dollar. Most of the move has to come from a weaker dollar, but that relationship is wrong, and you can see it in so many ways. That the capital flows that kept the euro down are beginning to unwind, we need to end up in 2 years' time at 130 for euro dollar somehow.
Kit, the road to 130. Where's the pain threshold for the ECB? Is it the pace, the level? What are you looking for?
It's the pace and how it happens. So pace, because you affect obviously exporters and also inflation, which is huge. So Philip Lane really wanted to put the brakes on when we moved up to 120 quickly in the summer. That worked. So we can go back there now without too much pain, but he'll be worried again because the Europeans don't want any more deflation. And then the way it's made up, because what really matters for the economy is going to be the trade-weighted euro and not just euro-dollar. The biggest unit in a trade-weighted euro is a Chinese yuan, which you've been talking about. If the Chinese will let their currency appreciate, you can get to 130 much faster. It's likely they won't let it get much further at all than we are now, And that is why the whole thing has to happen really slowly. But at the other side of all of this, you know, the euro, when it was trading 105, 115, was very artificially very weak as a result of ECB policies in 2014-15. And we have to go back and remember that. It is down here because of quantitative easing and negative interest rates under Mario Draghi.
Kit Dukes, the only reason I'm talking about the Chinese currency is because you talk about it and you taught me everything I know about FX about 8 years ago. I'm looking at Euro China right now, 5 days. 5 days, Kit, we've had a move on Euro Yuan. Now, I understand that the previous few weeks was a lot about dollar, broad-based dollar weakness. The last couple of days, though, China started to break down a little bit as well against the euro. How do you think this sets us up next week for the ECB, Kit?
I think it means that they continue to be dovish. I think they'll say something about the euro at some point to try to slow this down unless it steadies. So, you know, we've broken above 120, but I don't think we can just break quickly to 125. I think we have to stop here because there is no doubt that the ECB wants to do more. The problem for the ECB to some degree, and they'll talk about it quite a lot, is that as they've said lots of times, that they don't have that much room in terms of policy maneuver from here. What do you get by getting rates a bit more negative? What do you get with a bit more quantitative easing? What Europe needs is easier fiscal policy. So they can't, you know, they don't have the magic bullet they had in 2014 of let's buy all the bonds and cut rates to negative so that you all have to put your money somewhere else. That's not available. But they will push back and resist, and they will come out with some more accommodation of some kind.
Kit, this is exactly where I wanted to go, the question of the efficacy of central bank policy on FX moves. And there's a question, have central banks and their policies lost the same efficacy in perhaps manipulating, I don't want to use that word, loaded word, excuse me, in affecting FX rates? Or are we looking right now at actually the economy that's determining where we are seeing currencies valued?
Yeah, I think we're going back to a world where if we all have zero interest rates, and let's call them zero bond yields to keep ourselves happy, then all the countries with big current account surpluses will end up with overvalued currencies because they won't have an incentive to recycle those. What we've done for a while is we've kind of played with that and sort of changed it around with rates. So you managed to get, firstly, that the Japanese with Abenomics managed to get a very weak currency with yield curve control, bond buying, equity buying, negative rates there as well. And all of this becomes less effective. If you wanted a model for how it's not so bad, dollar yen went from under 80 to over 120. And as we've eroded all those relative interest rates away, as we've all started doing what the Japanese have been doing, we're only back at 104. So in a sense, the Japanese are still keeping their currency competitive here, for longer than I thought that they would manage, because of the, their aggression in terms of what they've done. So I think they still, the central banks aren't powerless, but the problem is you can't fight the current in the same way, because what was so successful was I moved my rates relative to yours. We all have the same rates now, almost.
Yeah, the race to the bottom. And so there's a question for the ECB next week that perhaps is what you're seeing in euro and where it's currently being valued, that if they can't really do that much to stave off the strengthening, why not jump on this consensus trade? Is that your view?
My view is the consensus trade, has to happen. That the market, the consensus trade is, they work because when we change a regime, let's call this the regime of post-COVID zero rates for a long time, the consensus tends to be quite good once that regime change is clear. And the danger is that as the consensus starts to make money, everybody gets on board it, because as all the doubters start realizing what's happening, and then you can't stop it. But if I'm a central bank, my only goal is to slow this down as much as possible, just like the Japanese have done.
Kit, it's great that we talked FX with you, and I can look at the history being made here as we go back to the 1980s and the Plaza Court. Kit, I've got to note a small soccer match this weekend. I call it a derby. Farrell calls it a derby, and I can't believe Arsenal's on the edge of relegation. I thought we'd never get here. They got to play the Tots. What is their chance against the Tots?
Oh, there are better side against good sides than against mediocre sides at the moment, I think, if I want to get myself some comfort. I hope that game puts some steel into the boots of the Arsenal players, and they realize that there is their duty to look after the happiness of poor people like me.
You're just trolling us.
North
Thanks a lot,
London
Tom.
duty.
John,
Kit, thank you.
John Farrell, jump in here on the importance of this game to London.
We've got to let him go, but let me say thanks to Kit, and then I'll talk about that. Kit Jukes, thank you, sir.
Thank you, Kit
of
Jukes.
SoxGen.
Thank
the
you.
importance of North London. Let's be clear about this, Tom. This is North London. Okay. It is the North London derby between Tottenham Hotspur and Arsenal. You pick a side, typically, if you live in North London. Which side? A North London resident, Kit Jukes himself, has clearly picked Arsenal. That is his side. So it's a big North London derby, Tom. Typically, over the years, Arsenal has come out on top in league position. This year, and over the last few years, Spurs have been far more competitive, particularly this year, fighting for the title. Maybe, Tom, your Tot's doing a whole lot better than Lisa's Arsenal.
Is the
Really?
Is that a good explanation? Did that help?
That helped a lot.
No,
I mean, just
it didn't
anything
help.
to grind Lisa into the ground. I mean, Lisa, does there need to be a coaching switch at Arsenal?
I just know that I picked a losing team yet again after all of the New York teams.
Lisa,
also.
you picked me and John. That's enough said right there.
So, you know, it's our anniversary coming up, Tom. You and me anchoring this show together. I've lost count of the years now. And whenever we do this, we are only doing this for you. No one else in the audience. We are literally just doing this for you.
There's an
From
audience?
London and New York this morning.
Happy
Good
anniversary.
morning. I hope. Thank you, Lisa. I think it's tomorrow. There's a picture of me throwing a punch at Tom somewhere on the day it all happened. From London and New York, for our audience worldwide, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Trump is expected to sign a bill that could lead to Chinese companies getting kicked off American stock exchanges. The measure, approved by Congress, calls for U.S. regulators to review the company's financial results. Chinese firms will have at least 3 years to comply. It may be President Trump's last chance to shape the Fed. The Senate is expected today to confirm the nomination of Christopher Waller to serve on the Federal Reserve Board. Waller has been the research director at the St. Louis Fed. In Germany, Chancellor Angela Merkel says the partial lockdown will be extended by 3 weeks. Bars, gyms, and movie theaters will now remain closed until January the 10th, and then government leaders will meet to reassess. The partial lockdown hasn't slowed the coronavirus spread in Germany. And it's another blow to the world's second largest money manager. Vanguard has lost a mandate to run at least $590 million in Taiwan government pension and insurance assets. That's due to weak performance. Vanguard has been overhauling its Asia strategy. It's pulled out of Hong Kong and Japan to focus on individual investors. And France is putting pressure on European Union negotiators not to make any more trade concessions to the UK. The French are warning they could veto a Brexit deal between the EU and the UK if they don't like the terms. Negotiators are trying to reach an agreement within the next few days. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I've dubbed this the golden age of fraud, in that prior to this, companies that are credibly under a cloud because of evidence would begin to underperform the markets rather dramatically. And now that's not the case, and in many cases these companies outperform the market until the companies admit the wrongdoing. And that's a really, really new phenomenon.
The legendary Jim Chanos there, Kinnikos founder and president, talking to Bloomberg Front Row. More on that interview available on the Bloomberg terminal and later on Bloomberg Television. From London and New York this morning, good morning to you all. Alongside Tom Keane and Lisa Abramovitz, I'm Jonathan Ferro, counting you down to the market open. The opening bell about 42 minutes away. We'll be catching up with David Balin, Citigroup Investments Global Head, on the open on Bloomberg TV in about 10 minutes' time, Tom.
That's amazing. And, John, I think it's going to be great to see David Balin optimistic on the market versus all the gloom I've had to deal with here today. I think, it'll probably be a good carry.
Pick a guest any guest. They're so optimistic on 2021, Tom. Just trying to look at what's happening right in front of our faces right now in the near term.
Guys, the anniversary is tomorrow. Save it for tomorrow.
But within the divorce lawyers on line 3. Okay, fine, thank you. I'll take them after the show. John Farrell off to his other property, probably will be soloing here in days as well. Michael McKee scheduled to make an appearance there as well. Right now scheduled to make an appearance is one B. Ritholtz, Bloomberg Opinion, of course, and a wonderful, wonderful must-listen podcast. It's just superb to have Barry Ritholtz with us on Bloomberg Radio and Bloomberg Television today. Barry, you have a gem of a letter on the fraud that is these outlooks out 12 months. You and I have lived this for decades. Would you explain the marketing nature of these outlooks?
Sure. Well, just ask yourself, how many strategists had for their 2020 outlook a global pandemic, 1 million deaths, a 34% market crash, and FANG and technology stocks doubling and tripling? The short answer is none of them. And I've had people say, well, that's a tail event. That's a natural disaster. That's unprecedented is probably the word of the year for 2020. But the unprecedented comes along all the time. What do we have? 32 new highs in the market? Unprecedented. The pandemic. Unprecedented, except as Ray Dalio loves to point out, unprecedented usually means you haven't seen it in your lifetime, but it very likely happened before. And just go back to the pandemic in 1918. This isn't remotely unprecedented.
But Barry, when I look at how we construct outlooks, and I'm going to give great credit to firms like Sanford Bernstein of ages ago, who tried to write more cosmic thought pieces to help us align up our thinking about having the courage to own equities. Are those pieces still out there, or are we now in the game of just guesstimating where the Dow will be?
I think a lot of those pieces have migrated from big Wall Street research shops because of the compression of commissions and transactional fees. They've migrated elsewhere. They've migrated to podcasts, to blogs, to longer, deeper think pieces that are really just designed to provoke a conversation, some thought, some analysis, as opposed to here's our outlook, and here are the trades you should give me now.
Exactly.
So meet my
exactly. Well said.
Well, look, it's very challenging to trade a market when, as you say, Barry, you can't predict the unpredictable, even if you look in the past 100, 200 years. So there's a question, how effective is it to just look at what the consensus trades are, to look at where people are positioned and figure out what's rich or what's perhaps a little bit less highly valued? I mean, isn't that useful on some level?
Sorta, kinda, not really. I mean, it's useful to let you know what's already happened, but markets are about what's going to happen. And while we certainly will all agree that trend and momentum have a persistency, what's going up tends to keep going up, what's going down tends to keep going down until the trend ends, that's good for a couple of weeks or months. It's not good for a couple of quarters or years. So really the question is, are you a long-term investor with a timeline that's looking out a few years, or are you part of the church of what's happening now?
So there's a larger point here, which is what's the point of active management if these outlooks are not necessarily predictive or useful in any capacity? And why not just go into an index fund and just take the long bet and leave your money there and not shift around? And frankly, that's what a lot of people have been doing, which is why you've seen an increase in consolidation in the asset management business. 2 deals announced today. I mean, is that the takeaway here, Barry, that basically you cannot outperform these markets actively?
So let's get a little more granular and a little more nuanced. I'm going to just slightly modify what you say. The average person, most of the time, is not going to be able to outperform the index. That doesn't mean there aren't certain active managers who have consistently outperformed the index. We know their names because they're so few and far between. There are traders who regularly beat their benchmark. There are lots of people out there who are doing this. The problem is you can't identify them until after the fact. And, you know, the rise of factor investing has come about because rather than engaging in individual stock selection, and don't get me wrong, there are people who are fantastic about them. About that. Think of Will Danoff at Fidelity, or, you know, Joel Greenblatt. Go down, I could give you 100 guys who are spectacular at it, but that still leaves, you know, 11,000 hedge fund managers and 15,000 mutual fund managers that are not.
Barry, we're out of time here, and for Bloomberg Radio, this is extremely important because Mr. Ritholtz is so cutting edge on Mandalorian. Where did you get Grogu, the baby Yoda, as we look to the screen on to our left and you on the right? That is the most coveted thing going, that you got baby Yoda. How did you do it?
Well, radio can't see this, but I'm holding up the box from Target. I ordered it.
Shopping channel.
I ordered it a couple of weeks ago, and it just showed up like magic.
Honestly, Tom, we're back to the shopping channel, aren't we?
We're back to shopping channel with Tarjay and Barry Ritholtz. Thank you so much.
That's right.
The most coveted thing of the season, Baby Yoda, with Mr. Barry Ritholtz as well. Lisa, what an interesting day, and I must note John's quiet about this pandemic. It really overwhelms all, doesn't it?
Well, it does, and this is sort of the discomfort that you're feeling with markets near all-time highs. I think it's interesting, my takeaway today is that the jobless numbers are so cloudy that they don't really matter. They're not really moving markets at this point because people don't know how to read them, and we've just come to accept incredibly high levels of unemployment every week.
Well, we had red and green on the screen, and then we had all green on the screen, and just fractionally S&P futures down 2, but a really constructive positive tone of the NASDAQ at these lofty levels. Euro 121.50, just off the recent surge of about 45 minutes ago as well. One of the conversations of the morning was Charles Cantor of Neuberger Berman, who sliced and diced Salesforce and Slack. He was fascinating on the why of this transaction. We'll delve into that deeper. Slack's Chief Executive Officer, Stuart Butterfield, at 5 p.m. tonight. Please stay with us through the morning on Bloomberg Radio, on Bloomberg Television. Good morning.
forma que esses governantes dirigem esse país pensando só naqueles que já têm muito e já têm demais. E é mais uma vez por isso que a gente optou por ocupar esses espaços, para que a gente lá de dentro possa exercer a mesma pressão que a gente já exerce na rua, de fora para dentro. A gente quer abalar essa estrutura.
Eu tenho muita esperança, tenho muita fé em Deus que aqui a gente ainda vamos conseguir a nossa moradia digna, a nossa casinha para, ao menos nos últimos dias de vida, se vender numa casa.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now with equity futures unchanged and near all-time highs. We begin with the big issue, America's deadliest day of the pandemic so far. Fatalities and hospitalizations hitting records. Officials warning of tougher times before mass vaccinations can begin.
The reality is December and January and February are going to be rough times. I actually believe they're going to be the most difficult time in the public health history of this nation, largely because of the stress that it's going to put on our healthcare system.
State and local officials implementing more restrictions across the country, including Los Angeles going into lockdown, ordering residents to stay home as the city approaches a tipping point.
My message couldn't be simpler. It's time to hunker down. It's time to cancel everything. And if it isn't essential, don't do it. Don't meet up with others outside your household. Don't host a gathering. Don't attend a gathering. And following our targeted safer at home order, if you're able to stay home, stay home.
It's a trend emerging right across the country in the United States. Economic restrictions piling up and another aid package still elusive. The pressure mounting on Capitol Hill to deliver more and more support. Democratic leaders now scaling back expectations and pushing forward with a smaller bipartisan proposal of just another $1 trillion in the, quote, spirit of compromise. President-elect Joe Biden echoing that message, urging Congress to work together.
This isn't a political game. We need to get help out the door as soon as we can. So I've been urging our congressional Republicans to work on a bipartisan emergency package now. But any package passed in this so-called lame duck session be now on January 21st. At best, there's only going to be a down payment on what's going to happen early next year.
The ball now sitting firmly in the Republicans' court, appearing for non-committal for now, but potentially making progress with the party's number 2 senator, John Thune, saying Democrats are moving in the right direction. They've got them reasonable, and I think that could get us a solution. Let's bring in Kevin Cirilli for more, Bloomberg Chief Washington correspondent. Kevin, great to catch up, sir. Some movement on Capitol Hill.
some movement in the right direction. And in addition to Senator John Thune, Senate Majority Leader Mitch McConnell, Jonathan, also weighing in and saying that this is being an effort that is being made in good faith on behalf of the centrists in the House of Representatives, led, of course, by the Problem Solvers Caucus, in terms of how they are moving on this particular proposal. Let's take a look at the specifics of this proposal, because it is now weighing in at about $900 billion. This is a significant departure from the $2.4 trillion that House Democrats had originally called for. It does include aid to state and local governments, a couple $100 billion on that front. Republicans like that it's going to be geared mostly towards schools, and an estimated $300 per week for some, those who qualify for unemployment benefits that would bubble it to about 4 months. So a lot to discuss here. Early indications from the likes of Senator Susan Collins, Rob Portman, as well as Shelley Moore Capito of Maine, Ohio, and West Virginia, respectively. Republicans in the Senate, they like what they see. And even conservatives like Senator Richard Shelby of Alabama are signaling that this is something that they potentially could get on board with.
Well, hopefully they can. The ball is starting to move. The Democrats have come in a good $1 trillion and more. Kevin, great to catch up. Thank you. Let's turn to Citi's David Balin, shall we, and get to his thoughts on the situation, expecting the recovery to accelerate despite major economic disruptions stemming from the pandemic. He writes the following: the global economy will recover more quickly and robustly from the COVID recession than after a more typical large downturn. The virus is an exogenous shock whose impacts are unevenly spread, leaving the core of the global economy intact. David joins us now for more. David, it's great to catch up, sir. There's something very uncomfortable about this moment for me, and maybe you can bring me some comfort. It's a market at a record high at a time when society's still struggling with the pandemic ripping through much of America. Can you square that circle for us today, David?
Well, it is a difficult circle to square for the reasons that you say. I mean, we're going through the largest healthcare crisis that the country has ever faced. We're doing so literally in an unprepared manner, and we are going to suffer deeply for the next 2 to 3 months. So that is the truth. But when we look beyond that, the miracle of the vaccine, the fact that a vaccine was created in 7 months, that technology has gotten over this chasm, and that when you look at the economic recovery that's already underway, it's pretty impressive. At one moment in time, we had 18 million people temporarily unemployed. That number is well below 4 million now. Permanently unemployed people are less than half of what it was in the 2008 recession. And so the recovery is already taking place very quickly. And the other fact, John, that I think is very important is that when you look at consumer spending right now, it is more than what it was in December of 2019. And that's with 15% of the economy literally shuttered. So when you take a look at all of that and the fact that interest rates are incredibly low, we think that the recovery, once it's underway, will be very, very sharp and very, very positive for 2021 and 2022. And that's what we're writing right now in our Outlook 2021, is that this is a time when investors have to do the opposite of how they're feeling. If they're feeling scared, they should actually be saying to themselves, perhaps I have too much cash and I need to be in the market and I need to basically get over this terrible crisis period in order to experience the benefits on the other side.
Is there any evidence right now that there is still too much cash on the sidelines sitting this out, David? Because we've just had a massive move, not just through this year, but particularly over the last month.
That's right. And one of the reasons why, people said after 2009, 2010, I have to keep a lot of cash because eventually I'm going to get into the market. And it turns out that people and investors are terrible market timers. This is one of those times because, like you said, markets appear to be at all-time highs. But in point of fact, that's not the case. There's a group of stocks that are well above their all-time highs in technology, media, and telecom, and a very large group of stocks in energy, banking, and all of the leisure industries that are actually 15 to 20% below their highs. We want our clients and we want, investors in general, people watching the show, to actually understand that how you build your portfolio matters a lot. And so they should be getting into those shares and holding them. And then secondly, people also have to realize that this is a time of financial repression, when governments are holding down interest rates artificially in order to deal with the debt issues. And 80% of the world's bonds today yield 1% or less. So bonds do not provide the diversification and the safety that they did for the last 20 years. Equities have to be a place where people go. They should choose dividend equities or preferred shares if they want to get income. But really, at the end of the day, in order to maintain their wealth in a time of unusually low rates, they have to be investors and look beyond the current crisis. That's what we're writing, and that's what we sincerely believe is the right advice.
Well, David, there's another way of saying what you've just said, that bonds won't offer you that diversification in your portfolio, so you should take more risk not less. Is that a fair characterization of what you're saying?
To some degree, that is a fair characterization, because clearly equities, even dividend equities, have higher volatility associated with them than bonds. But let me put a fine point on what you've just said, which is it is completely reasonable to believe that the 10-year bond could be at 150 or 175 next year. And if that's true, and if you're a bondholder, you'll not only have not gotten the diversification you wanted, you'll have lost money in your bond portfolio. On the other hand, if you take a look at how dividend shares have functioned versus the NASDAQ, they've done terribly by comparison. So we think that there's a lot of value in global dividend shares, which you can get both income and appreciation over the next 12 months at the same time that you will avoid that fixed income outcome. So that to us is really the trade-off. But you're right that equities are more volatile and you will be